What's up, guys, girls, friends, family? Scooter Squad, how you doing? Come on. There we go. Good morning, guys. What's up, America? Good morning. Let's pull up the Doomsday Bands. Take a look. You guys know we had a new release yesterday. I'm not sure if you guys remember. We had a couple of new features come out. I'll go through and review them. And the hedge distance property is there. Fantastic. Okay. All right. Let's take a look at, let's do a run length real quick. Market opens in 2 minutes. We're irrational out the door. So we're outside the Doomsday Bands, looks like. So market's going to be get out, sit out, stay out kind of thing. I'm long if we tuck back in the market. So I don't have to be looking at Rux here. I need to really get those impacts though. That really quick on NQ. I'm sure that's it. Great, let's do it there. Okay, so we're doing the red line technique here, so make sure I get this yellow line put here really quick. It's one of the techniques we teach at Rocket Scooter. Good morning, guys. Welcome to the show. First day here, make sure you go grab the Rocket Scooter free trial. RocketScooter.com link is in the description. Give us 2 minutes. Outside the irrational band, there is no call to be made. We had that catalyst. We'll talk about that today. How a catalyst affects the market during a trading session. So today's upward target, we will have 11,053 on NASDAQ. I'll have to do the one over S&P. Let's do this really quick. Okay. I like to come through and label these. Okay. All right. So both S&P and NASDAQ outside the band. Market's open. Okay, good. Let's go ahead and load it up. We're tapping an old December line. Let's see what VIX is doing. VIX is trying to connect to the October triple B, which is here. Keep an eye out today. If everybody needs a number to write down, 2713 is the number. Hit that like button if you can, please. That is the number to watch for VIX. This is going to be one of the major pivots today. Market's irrational out the door, which means pre-market check. We are outside of band. NASDAQ outside of the band. That's it. So nothing until we're inside the band. Signed up for the trial yesterday. Already had Discord access. Perfect. If you need anything, let me know. Just get situated today. We're probably just going to do training and watching videos. Market's irrational. There are no trading signals that we get off of a day like this when you open outside of this Doomsday Band. The market's too irrational to trade. I don't trade inside that band. A lot of our folks don't either. So capture this particular event yesterday. I didn't get a chance to do it on my charts. I was so busy. After the show, looking for specifically maybe here. I know the NASDAQs I use that, but the S&P I use this is a little more clear. Okay. What we're doing is a specific technique. It's gonna help us project the lows, and I'm just gonna take a little bit, maybe like a minute or two, just hang in here. Again, click that like button, you guys. If you haven't yet, say hello. This in the Discord. Discord link is in the description below. We have a free Discord, as a matter of fact. pushing towards our 4,000th member in Discord. We're excited to see that. Okay, so we're gonna start right here. No calls this morning. Market's irrational. I already noticed it out. So I'm not doing anything. I'm not making any new trades. We're gonna let the market kind of bleed a little bit. I'm just anchoring my red line so I can actually calculate how low this can go. It's a technique that we'll teach you in one of our videos. We'll go over this. So these three things I'm putting together are going to show me where the market's going to stabilize. This demonstration, I like doing these things manually. I usually do my homework off the stream. So how are y'all doing today? Good to see y'all. Welcome to the stream. Okay, so that's good. These are retracement targets for the day. So what I'm putting right here will be exactly where the upside limit is. The market does decide to rally, which I think it does. I think we're getting a lower low. And if we get a green candle that tucks into yesterday's red candle, that's a great sign. It means usually one more day of kind of choppiness, and then Monday we'll be back to rallying if my theory is correct. So today and tomorrow, choppy and flat, nothing's going on. Teach you guys how to read that. I don't think we're gonna sell off any lower than we had today. If we took inside the risk interval band, we should be good. Okay. Here's the red lines for today. We tap through and hit another impact, and we go through and delete that. This is just pre-homework I usually do for the S&P. I know it's a little messy to see all this here, but I'm going to teach you guys all what this means in just a moment. Let's do a downside. Here. So the extent of this run, if the FOMC was to, I'm sorry, let me go back here. It's not. Oh, there it is. It's shrunken so small. Why are you so small, guy? Oh, you know what? That is because that is not actually the yellow line box. Okay, so technique I'm doing right now is called yellow line. What it does, it will forecast a low. And that's what we're trying to do. Here. So what I'm doing is I'm building this week's move, actually, straight up from looking at all these points. These are cool techniques. We do teach you these inside of our training program. So you guys have not gone through, make sure you get the platform says. Am I having trouble getting the platform? Let me know if y'all are in and y'all are good. Okay. I'm gonna get Rocket Scare Fronts in just a second. We're gonna make sure we get these things done. Yeah. All right. So today, let's look at SPY. Actually, we have to reboot the platform here. Because we have a new release. So make sure you guys log back out, log back in for the new release. I'm gonna log in really quick. All right, how are y'all doing today? Irrational markets tend to be quiet. There's not a lot to say, but I'll go through some of the features. So first and foremost, we do our pre-market check. Market is irrational in the morning. Get the classic app loaded up. So today, liquidity map, bear long up. So if you guys have it in the Discord, I'll walk you through it today. The Discord has an area, and your dashboard will also have a link to it called the liquidity map. The liquidity map is going to bring up the little cheat sheet that we use right here. Will show me how to interpret the letters written on the top of the platform. BRLU on SPY looks like this. It is a support at hedge pressure where there could be buyers there, and we're looking for buyers to sell our hedge pressure right here. Now, with resilience greater than 0, that's one hell of a good sign that we're going to push through. And actually, I'm glad I brought that up now. We are in what's called a kind of a mean reversion where we're stuck in a liquidity pocket. Market's not going to want to really go here. So either my call is that we're going to go through and fill the gap, guys. We're filling the gap today. This is my call. Y'all see it? Questions? Everyone? Smash that like button while you're here. Smash it. Remember, filling the gap today. We're going to tuck back in the band. That's great. DD is 0.45, but we open outside the band, so that does not apply anymore. Resilience is greater than 0, which means that is support, and we're going to fill the gap if that stays above 0, which means it's a tap to 375 today. Okay, let me look at everything. I think we're good. Good spot today. Resilience is epic. Epic, epic, epic. You guys like that? Okay, so this is a play. BRLU. Support at hedge pressure to fill the gap. Love it. Okay. Taking a look at QQQ really quick. Resilience is epic. I know, right? I know. QQQ is a bear short down, so in the same light, there is resistance here. So what I expect is a trade to likely monthly hedge pressure as well on Qs and then stabilizing out. It'd be hard to see if we break that. Nvidia running right out the door. Let's pull some plays on the scanner. Let's do all the long ups today. And let's look for some play. I'm gonna do really quick. Y'all have never seen me do this with new features in the scanner. I'm sorting by all the long ups. And from here, I'm going to add 2 features. So I'm going to match what the S&P is doing. I'm going to look for things that are below half gap because S&P's resilience is higher. And I'm going to look for something that is above monthly hedge pressure. So we get some nice bull structure. And I'm going to sort by the new feature that we have, distance to half gap. And hold on, we did one more. Let's see if I have it. What do you name it? Quick. They have a couple new things on the release today, so I'll go through them later. It's called hedge distance. There it is. Hedge distance is distance between the hedge pressures. You guys have been wanting that for a long ass time. You don't see resilience in your account. So to add resilience or any of the indicators, you go here. And then you type it in. It's an indicator, so you're going to go to the indicator section of the platform and just add it. See that? Cool. All right, 1 second. So if you guys remember the distance, the hedge distance here is the distance between hedge pressures. So the higher the hedge distance and distance to half gap as well. So what we're going to do is we're going to go distance to half gap because we're going to expect with resilience greater than 0, something's going to want to go tap its half gap. So you're going to find the farthest one away with the highest hedge distance on a percent basis. Like Meta, for instance, has a long way to travel to connect with its half gap. Plus, it's the one that has on a percent distance the highest space between hedge pressure and monthly hedge. Actually, Meta also has. Let's ignore Meta. Look at something better. I've never used this one before, so I'm excited. Let's see. And this is a percent move, so this is a 1% move to half gap. So I can actually rank by the percent move I want to make, right? If I want to do mRNA, for example, it's a huge hedge distance and huge distance ahead. Let's double check this. Distance to half gap. 141. And then we can do, oh, let's add below half gap as well. So we have these in distance, okay. So this should be distance from half gap. These would be the ones that are the farthest away. As you can see, there's not much of a percent travel to that half gap, but that's what we look for. Cities a really good setup here, I would say. With res greater than 0, we expect to fill the gap. And then, of course, above monthly hedge pressure and a bear long up. That's definitely a long signal from there as well. You see how that works? I'm just giving you examples. I love it. Okay, I'm going to talk about my 3 big plays that I'm doing. I want you guys to hit that like button, though. I'll be right back. Don't do anything. I'll be back when y'all get 50 likes. Let's go. Click, click, click. All right, I'm back. Whew. Gonna have a 4-story house. I had to run all the way to the top, all the way to the bottom. Out of breath. Okay, make sure you go to rocketscooter.com. Everybody, let's walk you through the steps getting in. Just waiting on that setup to take off. VIX is hitting triple B, so we're good. I'm gonna walk you guys through a couple of things. First and foremost, if you're here for the first time, make sure you go to the Rocket Scooter website. If you don't mind for us. rocketscooter.com. Check it out. And go there. It doesn't take a credit card, nothing. You go there, you sign up. You guys do me a favor also. Do me a favor. Last night we were on the Trading Camp podcast with some friends of ours. Some really cool dudes, just well, new friends of ours. And they're fantastic. I want everybody here to do me a favor. Can y'all hear me? Go to Dwayne's tweet right here. Everyone do me a favor. Go to that tweet. Give it some love. I mean like some love. Rocket Scooter love. Support our new friends. Their podcast is amazing. They interview pretty much everyone who has a good head on their shoulders. You know, a lot of our colleagues, a lot of our friends. AJ's been on the podcast. Sim's been on the podcast. You know, but I want everybody to do me a favor. That link that I just put in there, go click it. Make like 2 minutes. Markets are rational. We're not doing anything. Let's do some housekeeping today. Go give that post some love if you don't mind. Just go give that post some love. Maybe your experience in Rocket Scooter, whatever. Heck that post count. Oh. Okay, so when market is irrational, we just wait, right? So this is what makes us better than everyone else, is we sit out and save our energy. You know, like, retweet, help them out, give them some support. They're growing their podcast and they're getting really big, really fast. I'm a huge fan. They're great dudes, actually, very good dudes. They have a trading group as well. So I think we'll probably have some a good relations with these guys going forward. Dig them. Super cool. I like talking to people. Alejandro's an engineer, which is kind of awesome because, as you know, engineering is our background. Our bread and butter here is all the stuff we've designed being nerdy engineers. So it's good to meet another one. Yep, let's explain all of them. Okay, right now the signal is to sit out for me, so nothing's happening. We're just doing a little housekeeping. So hang on 1 second. I'm gonna turn my laptop on, get charged up. I'll do a quick tutorial today as well. All right, so what liquidity map is it shows you where buyers and sellers can be. That is the biggest thing that we have here. It's one of our, it's basically the cornerstone of what we do, and I'll walk you guys through all the steps. Have you all access to Discord? Today we're gonna go through how to access Rocket Scooter, how to get situated, sort of thing. Markets are irrational today. We are below the lower DD band. Nothing is to happen. If resilience tucked below zero, the trade I said about filling the gap is over. So again, no acting until we're inside of the risk interval band. How you do that, I will show you in just a second. Thank you guys for all the love and support. Okay, let me ask one more thing of our project team. Okay, everyone just hang tight. In about 5 minutes, we'll go through like a little Rocket Scooter tutorial. Is wrongly showing absolute percentage? Yeah. Okay. So we have new indicators, new strategies coming out, and everybody gets situated. So in the meantime, go to the Discord first, sign up for that. I'll put the 2 links there. While you guys are waiting, I'm gonna get you guys situated. to a little bit of a training session. We'll kind of record this as well, and in our training videos we're going to keep adding things to get you situated. So first and foremost, go here. What's up, Kobe? Looks like you're aiming monthly equilibrium. I think today we hit the low and we rally, to be honest, next week. So when we hit triple B, unless we hit triple B on VIX and fly around and go the other way, market's probably going to stabilize here. So let's pull up the VIX chart. Everybody want to know? One of our major indicators of rationality is this line right here for the VX. If you go to VX contract / VX in a Thinkorswim, you will see 2713. We know that this is one of our secret volume pivots. When VIX hits that level, it's going to interact very wildly, very wildly. Okay, so this is, if there is a bottom to this run, and if my thesis is correct and the market does not go to lower lows, then we will hit this and reject it and rally. If this breaks this area here, we will collapse into the rest of the month, which ends on November the 18th. Can you explain mean reversion short up? Yes, we can. So what liquidity map is, and again, I'll walk you through it when everyone is here. Make sure one more time we just get the link out. And again, make sure you guys give that post some love. Support our friends there, and of course, support the podcast. I got up and put some pants on for it. Put in that effort for you guys. Go give them some love. Retweet. Not if resilience is less than 0. So this white line here needs to be back above 0. Okay. I'm going to walk you guys all through the steps, and I'm going to give you a little quickie detail on each one of them. Okay. And if you want to refer to this stream in particular as your steps, that's just as good as well. So let me pre-prep all the videos you guys can watch in that order, and I'll walk you through it. Y'all ready? First step. First step, everybody. Go here, click free trial, sign up. You get a week using the software. You get the classic app and you get the Rocket Scooter main app. I'll give you guys 1 minute to load it up, and then I'll go through the steps on how we get started. Markets are rational, and irrational markets, remember, we choose to sit out if we want to. I say we, I do. You're not following my trades. Disclaimer, not a licensed professional. I'm some random nobody from the internet. Don't base your investment decisions on me. Cool. Or anyone. But if you're following along to learning why I do what I do, why I choose to sit out strategically, one of the things you guys might have learned, especially if you heard us on that podcast last night, is that we have techniques and calculations that tell me to sit out. And I do, and I follow them. You ever had a rule that tells you to sit out? We have 10 of them. 5 of them can be seen before the market even moves, and those 5 flag me to sit out already. I'm not buying the dip, not doing anything yet. We're gonna go through how to isolate and see every single one of those. So after you go there and get the sign up, does anybody, let's get some chat going. Everyone in chat really quick. Do you have access to the platform? Let's get a big old fat yes in chat if you do. Remember, sit out day today. There's nothing to do but chill and learn something. So today we're going to learn something. And if the market flags that bull run up, we're going to go. If the market continues to leak lower, that's great because I get a lower low to buy on Friday or Monday. Everyone else? Everyone else here? Step 2, go to the Discord. There will be 2 steps you follow when you get there. I'm going to walk you through everything. if I'm writing some quick code really quick about this distance hedge pressure. Okay, you guys are all in? Okay, good. We're no action right now. And the rules that have me sit out are fantastic because I just know to sit out. Straight up. We're gonna triple B tap on VIX. That's one of our irrational signals. Okay, so let me ask you guys something. This is a vote. I need everybody to participate today. The bartending trader, what's up? Do you find a low on the TQQ? Yeah, so let's go through that. Let's look at QQQs. Yes, I think we find a low. I don't think we get it. I don't think we get a good reversal signal today unless the VIX collapses from here. If it does reverse, it reverses from right here or nowhere else. We have a volatility runaway today, which can cause the market to lose its bottom very quickly. So just help. Okay, so in the meantime, Rock Scooter folks, hedge distance is a new scanner parameter. I want everybody to come here and help me vote on this. We're going to clear out the scanner really quick. I'm going to show you how to pick place from the scanner on different setups, okay? This is really fun, but I need you guys to vote on something. We're going to change one of the rules here. Oops. Okay. So when you go to the Discord, the first thing you guys will see when you drop in is you're going to see something called Getting Started. Getting started is a bot check. Let me get my actually while we're sitting here. So if you have a hiccup there, let me know. You shouldn't. You should be cool. But if you do, let me know. Let me get my financial juice and other things front and center. And I'm going to give you guys Rocket Scooter 101 today. We're just going to walk you through every piece. What we do here. Okay. So my pre-market check, I'm going to walk you through my whole entire day. Lean, you go look at the jobless claims as well. I think that was today because that's part of my thesis. Investing. Financial juice. And the commando traders. Okay. Once you go here, you type in these words exactly. It's a bot check. Make sure you're not a bot. Like a CAPTCHA. Go here, click the rocket, click the scooter. Sorry. And that gives you access, and then everything should open up. Ask for help should get you to in front of a mod or myself. You can answer anything you want. Should give you guys your role. Some of you new folks that came in through here. Your roles. Okay. Training of videos is going to be your bread and butter. If there is a reversal, it is from here and nowhere else today. This is it. I'm going to walk you through it. This is where VIX is pounding against triple B. This is that reversal target. If there is one, it is from here and nowhere else. From absolutely here and nowhere else. Trust me on that. It's the only thing that can pivot the market today is volatility collapse. I don't know if it will. Markets are rational. I'm not taking that bet. We determined 3 things here in Training of Videos is your library for the next week. If you just got here, we determined 3 things here: an irrational market, a usual market. I'm about to drop some solid gold here. Google, when I got Google, Adrian, I grabbed it. I got like 30 contracts in Google before before earnings, just a small bite. And as Google's been falling, I'm positioning for 6 weeks out by grabbing some more, and I'm going to pick some different strikes. So for me, I've been scalping other things and trading other things, not just the Google play. If the Google play doesn't play out, it's not that big of a loss, because I'm literally buying dirt cheap options for a big reversal. If it doesn't play out, it doesn't play out. To me, that's more of a longer term decision. So for that, I know we have volatility in the Fed. So as the market was trading down yesterday and the day before, I was adding to the position. That's it. So I might have been down on the initial batch, but my Google trade is massive. I'm talking massive. So on the stream, when I show you guys my entries and exits on my day trades, usually on my swing trades, a lot of what I'm doing there, maneuvering and positioning, it tends to reveal as either a prize or a show off when it is playing, when I'm finally done doing what I'm doing. Not every play I do, I give all the info on. Sometimes daddy wants the big plays to himself. So today, no trades for me, not yet. Nothing new. But anything I add or anything I do, I will share with you guys. My ultimate play on Google, I'll walk you through the rationale for my trade though in just a second. So going through Rocket Scooter, getting guys started, get started, get access, ask for help, training of videos. This is a bunch of really, really cool knowledge bombs. These are 5-10 minutes a piece. They go through every one of my strategies that we've made. We've been making these videos all week using the new platform. Our big training videos are going to be on the website, same as these. There are 3 different levels: beginner, intermediate, advanced. There's gonna be a whole series of them, but they're 5 to 10 minutes each. You can watch them all in the day. I urge you to watch them all in the day. Watch every single one of them till the end. Getting started with Rocket Scooter is gonna mimic what we're doing here where Discord is and such. How do we predict volume instead of technical analysis? That is our bread and butter. We predict volume here. So let me get my stream front and center on my Twitter. Get one more post on my Twitter, and then we'll call it a day. How's that sound? You guys ready for the big training sesh? I'm excited. You guys ready? What's up, Matt B? We're watching BB VIX for bottom today. Absolutely. So let me walk you through some of the things. After you go through these videos, right, get started, get access, just get you in the Discord, ask for help, training videos. You're automatically assigned roles. If you sign up for the membership today, this coupon is your grandfathered in up to our 1,000th member, 50% off for life for monthly. Make sure you use that coupon every single month. You get half price on our data feeds, our platform, our techniques, our training, everything. It's cheaper than your paid Discord, that's for sure. Yeah, I'm not gonna trade. I'm not gonna really put too much thought into the PEs because in the state of the world of inflation, it's gonna be hard to gauge how much something will trade over earnings because the value of the dollar is so wackadoodle right now. Once you go through all of these videos, the first one is going to be how I do my pre-market checks to sit out, okay? Pre-market check is my 10-second risk management. I will get you the links really quick. Let me go to my YouTube channel here. And let me get the stream. So I'm gonna walk you through one at a time. And in this stream, we'll give you all the details you need to walk through everything I do within, you know, a 5-minute period. And I'm gonna train you guys on what's going on today. My pre-market checklist, there's 5 things that we do to look at irrational markets. Okay, this is one of them. This video right here, irrational markets are what help me sit out and not do anything. When you get access to the Discord, you'll see that you have trading chat rooms just like normal Discords. We have bots and indicators. Each one of them will come through and give you information every single day. It's things that aren't the platform yet. We use bots kind of as a stopgap till they get there. All of your strategy guides will be here in the red books. Your members area can chat, and then of course software wish list, help desk, everything. Anything you want to add to the platform, you can type in there. Tech support, you got a ticket, you can type in there. That's about it. So we're going to start at the first place is we're going to go all the way down to liquidity map, which will give you the cheat sheet or the playbook as we call it. The playbook is for analyzing these letters you see on top of the screen right here, bear, short, down, whatever you see. You connect that with this and it shows you where liquidity can be from here to here, here to here. It's as simple as that. Okay, bear, short, down has a general downward trajectory off of that blue hedge pressure, down off of that blue hedge pressure off of that yellow as well. So these are both high selling targets on QQQ. So you see there's that pressure down, just like it shows. Liquidity map is amazing. It is what put us on the map. It's what got us into a podcast last night to talk about it. We were on a bunch of spaces over the year talking about it. People are interested in seeing a new type of analysis, a new way to see the market. We're really excited to have you guys here to check it out. No more technical analysis here. You can combine what we do with technical analysis. What I would do, if you have your own system and style, you can use hedge pressures as major pivots to know that when you break through them, the market goes crazy. They're my stop loss areas as well. So in the liquidity map, for instance, the legend is here. And if I'm trying to long something that says BLU, for instance, and the market falls below this yellow line where there is no arrow, you can just say the market's illiquid. So getting liquidity map in front of you, easiest thing again. So when you get liquidity map in front of you, you will see that each one of these letter codes corresponds with something you'll see at the top. If I'm trying to long in something that says BLU and the market falls where there's no arrows, it's illiquid. Illiquid markets, I do not want to be on the other side of the trade when the market is illiquid. There's no buyers with me, I'm the only one there. Same thing here. If I'm trying to short a BRSD and the market goes where there's no arrows, it's illiquid as well. I get out of the way. It is a rock solid stop loss strategy for me. I do not trade where there's no arrows. I sit out. Doomsday is another one of our indicators. This is extremely powerful. It's what's happening today. Doomsday, if you watch the video I just linked, is one of the 5 things I check every morning for irrational market. This will tell you about how that works. Trading strategies will show you all of our indicators. We have 14 of them. 2 of them are lumped together here. and 2 of them are lumped together here. Each one of these indicators predicts unusual volume. You guys are used to hearing about unusual volume. We will predict the unusual volume before it happens. So instead of waiting for the platform to go ding, 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 there's unusual volume here. What's cool about rocket scooters, will give you the level where that unusual volume will take place at every time. Today in SPY, it's going to be at the hedge pressure level. Anytime you touch hedge pressure, there is unusual volume. As you see right here, this volume spike is as much as the open because we touched that monthly hedge pressure. Now we're touching hedge pressure here. Volume spikes very heavily at these hedging levels. This is where market makers are balancing their position at the maximum amount of order flow. We will predict the maximum order flow of the day of market makers hedging options they bought to zero out their risk of trading against you when markets illiquid. Markets are illiquid. I mean, it's a beautiful concept. So we're bringing it to you so that you can see where the market actually is bullish and bearish and where hedging is going to take the trade one way or the other. You ever hear the words like gamma squeeze or delta squeeze? This predicts or shows you where the gamma squeeze and delta squeeze takes off from. I will go through each one of these indicators one at a time, but they're in this priority here. The highest priority is number 1, the lowest is 12. In this order, the higher on the list, the more volume it will produce empirically over time as we looked at all the times it happened. So a catalyst, for instance, yesterday produces massive amounts of volume after FOMC, right? Look at all that volume after the catalyst is humongous, right? That's the highest in the list. You have 3 categories. We have other things like yellow lines and red lines. So I'll be doing some of this this morning. Individual stock catalysts, risk intervals, etc., etc. Liquidity map and half gap. You'll hear these words a lot. Liquidity pocket, yellow line, red line, resilience, and risk interval. These are all my pivots on where I act in the market. Checks are usual, unusual market. Market's unusual, I bet small. Market's usual, I bet big. The initial checks, irrational, rational. Irrational market, I don't trade and I sit out. If you go to the next thing in stop rules, there are 5 things in that video I linked. Will go through a detail of each one of them. If I flag any one of these 5 rules, I get out, I stay out, I push this X in my platform and close down. I don't trade, and I go enjoy my day and try to forget about it, right? I don't even pick up my phone to look to see, well, I wonder what the SPY's doing today, or the S&P, you know, is it going up? I know I got out, but maybe I should get back in. Once it flags, you get out and stay out. So it's actually rules to help you prevent over trading yourself. BBB worked like a charm. Absolutely, it worked like a charm. So here are the 5 things this morning we checked. When VIX travels more than risk interval, I'm just going to go through them one at a time. Nope. S&P open below the band. Yes. Catalyst. No catalyst today. UVXY call wall. Let's check. Again, this is fast. You'll get as fast as I am. And you can make those inferences at the start of the day. UVXY call wall. Yes, there's 2 of them. Bull zone. And actually, let's go ahead and I'm going to change those words to bull zone. It's a little bit more intuitive for what the word is on the platform. XY. Oh, I already have it there. Bull zone object. Okay. Bull zone. A lower boundary of the zone. Okay. Oh, 4,009 characters. No. Yeah. Any one of these that flag, I sit out. So 2 of those have flagged, and break of hedge pressure, monthly hedge pressure is another one. So the SPY is the first place we look, and the UVXY is the second place we look. Trust me on why it's UVXY. There's a whole lot that we do here that's different and unique. UVXY is one of the best measurements of the VIX because it's a tradable thing, and it has very liquid options. We used to use VXX, but these are great indicators. Okay, so today we are in an irrational market, so nothing is going to happen. I'm not doing any trades, letting the market bounce around. Again, I'm not chasing the high, not chasing the low. One of the things I look for usual markets, which is the next step, is this triple B thing right here. Again, referring to trading strats, you go to the top. I'm sorry, irrational market as well. If the VIX is above this level, there are loose pivots and a lot of overshoots. If the VIX is below this triple B, razor sharp pivots. So this has to do with contango and futures as an exploit of what happens when futures roll over. Firms change something and it causes a lot of hedging at this level. Let's just say it like that. When I said this morning, if the market reverses, it reverses from here and nowhere else. When I made that call, it was pretty bold, right? Because that is exactly where it pivots. And if you don't believe me, there's your volume spike. Again, every one of our indicators will predict high volume. We give you the volume profile before it happens. That's what we do here. There's a trader, I know where volume will be. I'm only trading where volume will be. And once you spend about a month or so here, you'll be an expert at this style of analysis. It goes hand in hand with your technicals. If your technicals are oversold, right, and this is approaching a level you know will pivot, then you just don't enter when your technical is arbitrarily like 80 on your RSI is like 20%. Whatever, you wait until you get the level you want and then you take the action, right? BBB rocked today. Oh, you know it did. Thank you, Pseudo. Okay. Thanks for explaining dynamic hedge first in the index futures. I was able to test it last night after not knowing how to use them for a month. Oh, nice. Okay. So here, the market, if you are rejecting this triple B and volume is dying down and you stay below it, then we will coast higher in non-volatile until November the 18th. This is a month-to-month thing. VIX futures price in a month at a time. Usually on an event like FOMC, you will test that triple B. And if it fails to create additional volatility, then yesterday we proved that FOMC was already priced in. Yesterday we predicted that we wouldn't raise more than 75 basis points. Yesterday we predicted, this is before, and a month ago we said that J. Powell, as long as the unemployment numbers were ticking up, the unemployment filings week over week, that J. Powell would change his commentary to say they were going to be less aggressive on rate hikes. Didn't we call that? Literally call that. The thesis is perfect. We said that day after day after day. Okay. Filling the gap on SPY as the upside target if resilience is greater than 0. That's it. So if we reject this triple B, we are coasting lower through the 18th, which is great because my positions are after that expiration. This is a really interesting concept. We have a video that covers everything. Now, if you want to look at the S&P, the Doomsday Band comes from a bot. And we're about to get this programmed into Rocket Scooter as well. We still manually do it. The rule of Doomsday is actually really cool. This is an exploit of futures and futures margin requirements. There's hedging that takes place at these bands. And again, everything we do here predicts volume. Anytime you touch one of those bands, you will see volume come out the woodwork no matter what. Let's pull S&P front and center. That band is calculated by a bot. That number is posted in the risk interval channel. These update once a week. Get familiar with them. If you're trading stocks, doesn't matter. Anything you're trading, know one of these numbers, the S&P. 2750 is the most important number you're going to remember in your entire life, and every Sunday update that. The S&P's risk interval level controls the entire stock market, I promise. That number there. So what the bands do, it's just we have an automated thinkorswim script that adds and subtracts that number from the close of the futures. I know it's a lot drinking from fire hose today, but if you watch all those little videos, I'm just detailing them all one at a time. Right here, 2750 lower, 2750 higher. You can see that when you get there, the market has a lot of hesitation, has a lot of volume. In the middle of the night, you can see that there's a lot of random activity the moment you tap it. The highest volume in the overnight session right here is when you touch it. Volume spike when you pass through it. You see how volume is ramping up, ramping up, ramping up to that huge volume. Again, we predict volume. And then selling off from it is even the largest volume. These levels predict volume, and you get them at 5 o'clock before the market, or 4:45 Central, which is 5:45 Eastern, before the futures market even opens. We give you these levels. That triple B, you calculate that on the third Tuesday of the month, and it stays there all month. So all of these are calculations that you can do before the market opens or overnight, and do all your homework not live in the session. So this doomsday band is what we call it, is that anytime you're outside of this band, the market is irrational. How many people chase the short and just got burned? We know irrational market means unpredictable. We don't try to trade. All your gurus out there, all your trade room gurus, everybody, or they're calling highs and shorting at the low. We are not doing anything in this choppy, flat junk. Outside of the doomsday band, I mean, I say we, there's no we in trading. It's literally just me. But below the band, you don't want to be susceptible to this. Instead, you want to wake up to this and say, I don't feel like putting pants on today. I'm probably just going to go to bed, sleep it off, have a good day, and have it run errands day. And everyone's trying to guess what the S&P is doing today, and you didn't do anything, and the market literally went nowhere, and you knew that from the start. Outside of these risk interval band, if you are outside the band, it's irrational. Don't enter new positions or try to think about the market. Right now, from the start of the day, I go, well, market's going nowhere. Let's have an educational session. The first thing I said was sit out day, market's going nowhere. And market has gone nowhere. As a trader now, you guys are empowered to be able to see that before it happened, okay? That's it. Do you like what you're seeing so far, everybody? So far, since you've been in the stream, you heard me say I'm sitting out and doing nothing. You heard me say that the market's going to go nowhere. You've heard me say if the market's pivoting, it's pivoting from here and only here and nowhere else the moment we tap that triple B. It's almost like I'm calling a play-by-play before each one of them happens. Now, it doesn't mean that we're super gifted at everything in market, but we understand why markets move. Hopefully we've proven that to you, especially with your first day here. You guys impressed so far? It's not hard to do this. You can do it yourself. And so we're going to train you on this. Remember, if markets are going to pivot, it's from here and only here. It's a solid rule that we have. Outside of the band, I'm still not making the trades here. And I said market's going nowhere. So far, so good, everybody? You'll get really good at this, I promise. If you are inside the band, here's the next rule with Doomsday. This comes back to Rocket Scooter. If you're inside the band when the market opens at 9:30, the ratio that is given to you by our platform, 0.45, if that ratio is greater than half, 96% of the time, if you open in the middle, you will tap the upper band. 96% of the time, if you open in the middle and it's less than half, you will touch the lower band once in the session. Now, that includes the overnight. So an example is the S&P touched the band before the market opened. It's not a trade. If you float in the middle and you just stay in the middle, this has to do with margining risk. It's a whole cool thing that happens with this. Like I said, each one of our things is a very simple, it's just a line on a chart. There's no studying, there's no confluence, there's no multi-charts, there's even no candles or time frames. It's eliminated all the complexities of the weaknesses of technical analysis. An example here, we opened inside those two green bands. And if DD was less than half, it touches the lower band at least once, and that's it. So if the market is trying to struggle here and it's less than 1/2, I have a trade idea, then I can short from here to here and put a stop to make it greater than 1-to-1. You guys all see that? So today we were outside the band in irrational. We did hit a run length red line, which again is another pivot that I previewed yesterday, and we talked about that being the low post Fed. That is the low that I need the market to support. And I say run length, that's actually an impact, I think. Let me double check. Yes, that is an impact, actually. Let's go back to here and let's label this one. Yeah, it's an impact. So we had another calculation. This yellow line is now deleted. Oh, and yellow lines and red lines predict larger pivots of illiquidity during basically events. Like this event has a pivot. This yellow line is calculated off of this event. Another technique, red lines and yellow lines. This is a volume pivot that's predictable. This is a volume pivot that's predictable. And you see that there's a huge selling wave there and a huge consolidation and pivoting range there. And even FOMC tapped it and rejected it and then fell to the range that, as you see right here, where that reversal also was. Red lines and yellow lines are beautiful. They're all part of our suite of tools. Going back to trading strats, just to revisit, so far we've covered we've covered the risk interval. We've covered that triple B. This pivoted the market today. The bands. Covered yellow line and red line as pivots. We've covered liquidity map volatility. Fixed call wall. Let's go through some of the major things of Rocket Scooter now. Now we've got a foot on the market. We are back to being rational in here. Now we're going to consult Rocket Scooter and we're going to see what's going on in the market today. Good to see things are nice and rational again. Okay. Any questions so far? Let's consult our stop rules again. This is a no. We're inside the band, so that's a no. No catalyst, that's a no. UVXY still in call wall, that's a yes. So let's double check that one last one to make sure the market's pretty cool. If UVXY drops below 10, then all of our flags have cleared. Market is clean at this point. This is the only bounce point that's left for the market to become bearish or irrational today. If this rejects here and breaks through hedge pressure, groundhog sees its shadow and we're going to tank for the rest of the year. If today we collapse through 10, this will be the strongest rally you've seen over the next 2 to 3 months since the market started selling. Okay, this is the only pivot we will see today. For the entire stock market. That call wall is still active. So I expect us to see some volatility almost immediately in the S&P. So now let's pull Rocket Scooter up. Keep an eyeball out on that UVXY today, you guys. And I'm going to put it on my own thing here. Make sure we're in decay, which is great. Okay, so now that market's stable, remember, we're making sure market looks good. Let's go ahead and consult what the liquidity map says. So when I see liquidity map bear long and up, I will consult a little drawing. That's really cool. And bear long up is telling me that hedge pressure is going to be a wave of buyers on the north side of it. And as a matter of fact, if we keep rallying into bear territory, it's going to hit that next resistance, which is usually another video that goes over how I pick my price targets. So what is the next resistance? It is called the 4 secrets to picking price targets. We go over yellow line, red line, half gaps, monthly put and call walls. And those are my 4 ways to pick my price targets there. Okay. So watch that video and we're going to talk about the different ways SPY can go. So today, SPY's, the first thing you always do is you mark your gap fills, okay? So we go to a daily chart. We're gonna look at where all the SPY gaps are, and we're just gonna mark them. I'm gonna get my line tool right here in the chart. Let's do a horizontal ray. And on the daily chart, you can see that SPY has gap fill clearly from here to here. Couple more. SPY has a gap fill from here as well. So my upper targets are at least to fill the gap. And I always take the next one. How awesome, folks. That was awesome. Triple V VIX told us everything. You're right. Yep. I think right here. Get a little note in Discord really quick to my team. The SPY's gap fill from yesterday at 13 o'clock. At 13 o'clock. 3 o'clock my time. 4 o'clock Eastern. 16 o'clock. There we go. That's the word I'm looking for. Is right here. So the gap fill is going to be right here. Now, the next thing we look for when talking about gap fills is the half gap pivot and resilience. With resilience less than 0, this is going to be resistance. So this is telling me I got a little bit of volatility. Like I said earlier, man, I'm calling it play by play. I said, if the market's going to pivot down, it pivots from there, and it did. And that's exactly what we saw. And with the resilience less than 0, what this white line is one of the most powerful things that we have. This white line is a gap fill predictor for the S&P. Gap fill predictor before it happens. It's practically team here, practically never wrong. This is a very, very, very cool leading indicator. The moment resilience is less than 0, we know all day long that this is resistance. Res is greater than 0, then this is support. So as an arbitrage opportunity, when I said this morning, we might rally because if this is above 0 and we're trading lower, the market's going to try to go up and fill that gap. It's a very cool concept. And so the redistribution zone is between the open and close of the day, right here. Very small today, but if resilience is less than 0, you can just draw a line like that. So as long, and one of the things of the platform is we're actually going to have it do that for you. So maybe, you know, above the current candle or somewhere right now, it will show a line just like that, showing that that's the high of the day. So if I would have bought off of that VIX triple B and market would have pivoted higher, I would have sold because res is less than 0, meaning that half gap is resistance. They're color coded for a reason. White is the tiebreaker of the white. Yellow is the tiebreaker of the yellow. When the S&P gets to here, SP resilience you can add by going to indicators and typing in resilience and adding it. This is an aggregate of all the stocks doing the same behavior and hedging themselves into that redistribution zone. It's a rate of implied hedging. If it's less than 0, this is the 0 line, then that is resistance. I don't expect it to blast through there. Not yet. And as we're getting up this high, I would have taken profits on my first scalp had I been in one, but market's irrational. And again, we've gone absolutely nowhere while we're waiting for the market to pick a direction. If this goes above 0, and that is above 0, then we are going to here to fill the gap as a trade. As long as this line is above 0, then I am longing the market from here inside of that liquidity map, because the liquidity map shows me that in a BRLU, hedge pressure is a place where buyers will likely be. And if the buyers are not there when we tap it, then I don't want to be long below it. So again, if we get here and these buyers don't step in, I don't want to be long anymore. We already have the indication that this is resistance. Check. Other indication is, let me get a different color here. We need buyers right here. Oh, that's huge. You'll see that? So in a bear long up or bull long up, we're kind of jumping between the two because there's a bull and bear territory. Either way, they both have a similar action point at these hedge pressures. So as I'm touching it, I want to see that volume come through and float the market. And the combination, when the indicators disagree with each other, you just know it's going to bounce around until it solves it. So putting all the pieces together, resilience is less than 0. It's been less than 0 since here. So from this moment in time, 10 minutes ahead, I know that's the high of this round, right? And you guys that have been here, have y'all seen all these little micro calls I've made, like 6 different things? They've all pretty much been right? I'm sitting out, market's going nowhere, check. Market's irrational, check. If the market bounces, it bounces from only here and only here, check. If the market's going to sell off, it needs to sell from here and only here, check. I picked both of those pivots before it happened. I know that this is the high right now while resilience is less than 0. When you put all this together on the Rocket Scooter platform, as we start to evolve and make more things for you guys, we're going to have it all drawn out very simply and easy on the platform for you. I'm just really versed at the manual stuff, right? So now that I know that we have conflicting signals, bull long up is support here. Resilience less than 0 is resistance there. And now we're sandwiched in that range. I'm going to wait for one of them to break, and I'm going to chase that long if we get it, and I'm going to avoid that short if we don't. Why am I going to chase the long and avoid the short? Can you guys tell me if y'all remember anything? Why is chasing the short a bad idea for me and my style of trading? It's not a bad idea, but why does it conflict with what I normally do? Do you guys have a question? Have an idea? Because I'm permeable. Shut up, Alan. No, just kidding. Yeah, well, that's actually partially correct. But if the sell side goes back into outside the doomsday band, right? But I also, right, another thing is I don't short unless it's against monthly hedge pressure. Y'all are hilarious. But it's because it's going to go back to being irrational, and I just don't want to be in a trade. The market, the sell side is still in the irrational territory, right? So I don't want to be in a trade down here anyways. That's just not a good trade for me. By the way, if you guys are just tuning in, I'll just remind y'all, we were on the Trading Camp podcast yesterday. There's a YouTube video of it. You guys can see me, just like you see me now, chatting with the boys there. Had a great time. If y'all know, you know, Alejandro, if you know those guys, Dwayne, stellar dudes. I'm going to go and I'll give you all the link to that podcast if you want to listen to and watch it. I tell my whole story. Essentially, I tell my story of my life, story of trading, how I got to where I am, how I used to really suck more than I suck now. I'm less terrible as the years have gone by. Then Matt is an incredible guy with a great story. It's really sweet. I love you guys. Y'all are the best. Very inspirational story. Make sure you guys go here, give that tweet some love, give their post and podcast some love. Yeah, so on the downside, we're still irrational. I don't want to be in a trade down in here, so the short trade is just less appealing to me than waiting for that long to go through. So now that we're sandwiched between the two, all we're waiting for is resilience to be above 0 to show me that resilience, that half gap is now support. These are all in the videos, and again, we're going through like 14 indicators all at once, but they're all like night or day decisions. It's not complex analysis of a bunch of shapes and colors and patterns and, you know, stick figures on your chart of a guy, fishing, a sunset. I mean, people's charts start to look really funny. They literally look like the opening scene to New Hope, where you got pew, 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 laser beams, all kinds of different colors. I mean, this is what people call modern trading algorithms. And they look like this, and they usually sell them to you in some bootleg third-party platform. And it's just nonsense, right? And you sit there and you wonder, and you have to look at those laser light battles on 19 different time frames to figure it out. Ooh. Ooh. Right. We eliminated candle time frames. They don't exist anymore. You don't need time. That cuts your charting by 90%. Some people open up a chart with the 1 minute and open up a chart with the 5 minute. You guys learn this way. I know. Open a chart with the 10 minute, open up a chart with an hour, open up a chart with 40 hours. I don't know, 80 hours. And you have all these charts for like one ticker. I have a 1 minute chart on SPY and I make all my decisions from it. All of them, 100% of them. Not worried about the bear walls? No, because when you squeeze into bear territory, walls aren't resistance, just the boundaries. So if I'm rallying into today's bear zone, I will show you where that resistance is. So I'm just kind of showing you how technical analysis gets you somewhere, but it's really complex and it's more complicated than you think. So the idea of what we have is to show you where pivots and volume can be without a lot of noise on your charts. In reality, in the last 20 minutes of me talking, you've learned almost everything we have. It's a very well-oiled system that today I said market's going nowhere. I'm not taking the short. I said the market was going to pivot right here when it did. I said market's going to pivot right here when it did. And now I said we're going to be sandwiched between here while resilience tests this zero line. Each one of these things I called before it happened. It doesn't mean I'm a brilliant genius. It means I know how market making works and how these robots are trying to find liquidity in the markets. I can literally play by play my scalps and choose to sit out. I know it's really excitable to go to a trade room. I had some trade room people mad at me yesterday when I was talking about trade rooms. You remember on the podcast, they were talking about how COVID generated a whole layer of penny stock pump and dump gurus. And of course, just gurus in general, right? Everybody decided they got furloughed after taking a trading course of their own and joining a Discord. People got smart and decided they want to start their own. And there's a lot of people out there that did that. So I got some pushback from some people. Hey man, what are you doing? It's like you're rocking the boat. Like, what do you mean? I'm just saying that COVID created a bunch of trade room gurus. And all I said was that you guys as traders should always ask everybody who wants to charge you money for call outs. Right? We don't do call outs. I don't do call outs on our Discord. I don't post me like you post your plays. I'm like, nope. I have some friends that have trade rooms. You guys can go over there if you want to see someone's plays and follow them. That's the quickest way to lose your money trading, and I promise you that you will lose your money trading following anyone's call outs. There's no way that you can follow somebody's trades and work. If that was the case, I would do it, and I would never get up and trade myself. But people are a little bit mad at me for saying that. I guess they don't want you asking questions or whatever. So I think that it's silly if you go out there and don't ask people who show you. I remember somebody got busted or you read them all the time. Guru Leaks bust them all on Twitter just for being like they're showing off pictures of a Lambo that they rented or posting a picture of a 10 million% gainer that really was just a paper trade. Right? It happens all the time. So I tell people our job is a risk management platform. Our ethos, our dogma, everything we hear is to tell you to ask people to show you their real trades. I'm not in trades right now, but when I'm in trades, I show you. That's it. Magic Mike faked his own death. See, I don't know who Magic Mike was, but I remember the story of somebody faking their own death. Isn't that crazy, right? You get the goofiest stuff out there. The goofiest stuff. Literally high school kids sitting in their algebra class, tweeting their call outs. You paid them $90 a month for it. Then you didn't ask them if they showed you their trades, and that's what I'm saying. You stop. But anywho, like I said, we're here to teach you how to trade. Don't let people hold your hand and walk you to the doorstep. I'm showing you how I look at markets so that you can look at markets yourself. The only way to the top is that you're going to crawl your way there. I promise you that you're going to have to learn the business. You are trading against people like myself and others who have carved their way through this industry. I wasn't always that great. I'm not saying we got that great right now. But I'm saying is you're not going to come in and just join the crew. Trading is a zero-sum game. The first person in is usually the winner. So if the person that made the call out won, then in cascading order, the second person makes less, third person makes less, fourth person, and then the rough majority of everyone that followed it also lost, because as the first person was selling, the last person was buying. And so money exchanges hands in trading. I think people are naive to think it's just created. So when you follow call outs, you and 1,000 other people are following one person's trade. Who are you trading against? Each other. I mean, it's really silly. So ideally, what you want to do is see something before it happens. Like when the market was selling, a good market's going to pivot. Which everybody else is like short, short, short. And I'm like, well, market's going to pivot, right? So the idea is that I'm not throwing you under a bus or taking jabs. It's a general comment. As Rocket Screw is a platform about risk management, there is risk in you not vetting your trade room pilot. It's an investment just like a stock. And no offense to anybody out there. A lot of my friends have trade rooms, but don't give a fuck. You need to ask them for broker statements. And if you don't, you're silly. And that's what I said yesterday. So you deserve to lose your money by thinking child will lead you to the top. That's all I'm saying. And that's honest. And it's very honest, right? You guys have to ask people who want to charge you for their plays to show you proof that it's worked for them, or show you proof they're actually playing. Because a lot of the paper, again, not saying anyone's paper trader or calling anyone out in general, but you have that obligation. The whole speech yesterday was to inspire you to not let people, and it's the same thing in the podcast. The whole conversation was this. The podcast was about a lot of stuff. And we talked about how traders don't have any idea what they're doing when they get in. And it's dangerous. They get in, they see somebody make 1,200% options. They go, ooh, that could be me. They come in, they see people with call outs and everyone else following it. They go, maybe I'll just join the herd. You go in and say, ooh, there's lines on a chart and this guy showed me this thing after the fact. Maybe it's going to work. Let me buy it. It's a dangerous world where it's easy for you to get tricked. And a lot of people have that gambling mentality and no control. So when you go into a world where you sold an idea and someone says, hey, stranger, let me take your hand. Follow me. I'll show you what to do. Okay. They're not giving you control as the first thing that they teach you. Follow me. My first question is, yeah, where's my parachute though? In case I need to bail, right? No, bro, follow me. No, right? What's your risk management strategy? Do you actually really even trade, right? These are things that you should do for everything out there in the industry. It's really honest, because as a trader, your investment into a person is just like your investment to a stock. You're not gonna not do your homework when you buy a stock. You can do your homework when you buy into any program. Again, everyone's, I guess some people that I was taking jabs at them specifically, when I'm not taking jabs at anybody. I'm taking jabs at you as traders for being silly and expecting that to be your way to make it to the top. There is no way to the top other than hard work and getting your ass kicked like everyone else. My podcast is how I carved my way, by getting my ass kicked. And then what I carved, I built into a risk management system that kept me skittish on the market to keep me from doing anything crazy. Now we're filling the gap with resilience still less than 0. So I'm not expecting the market again to rally from here, but it's looking pretty good going forward. It's the best platform you've seen around. Definitely have to learn and understand the principles. As we're building it, every week we come out with something new. We're trying to find ways to make everything easier for y'all. And we actually have some style consultant on our team now that's going to be looking at the platform and making sure it's easy to understand. One of the things is some kind of system that we thought would be alerts, right? That you can program anything you want. And the alerts can be, say, like you make a watch list, which we'll put on here, and alerts can be like hedge push or break up, hedge push or break down. And they can just show you the stocks that hit all your alerts or your criteria. Whenever you program the scanner, the alert will tell you when a stock pops up on the list, or a system of arrows. For instance, we would draw all of our calculations on here. Great idea. Pretend that you had a red line here, and the platform will draw the red line. Pretend at this moment in time resilience is less than 0, which will have an arrow there. Pretend at this moment in time, actually pretend this is what's going on. That's support. The liquidity map on BRLU shows that I'm expecting a hook like that. And then any break of here goes to the next resistance of the red line, right? So they have everything drawn on the chart for you in a way so you understand the pivots in a simple way. And the next step would be if you were to put your hand over, or your mouse over any of these. Like if I were to put my mouse right here, maybe something can pop up that can teach me what's going on. This is resistance because resilience is less than 0. Here's the video on that. This is support because that's greater than 0. Here's a video on that. Whether you mouse over, like I like the idea of putting a question mark up here, calling it interactive mode. If I click the question mark, each one of these things become interactive on the chart. Something like that. Y'all like that? So I can click, I can highlight or mouse over, pop up. Highlight and mouse over, pop up. Tips and tricks. Another thing is market's crashing, 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 and you're not paying attention to the VIX. The platform guides you to. Right here, a giant exclamation point pops up. The warning. Your alert will say, warning. This is the indicator. You guys like something like that, right? I mouse over on the warning. A warning pop-up says, this rule. Here's some information about it. Here's more info. And then, of course, you can click the button and it will split the chart and put that chart there for you so you can watch it. Or auto, we call like manual help, or we can call like auto help, which would do it automatically. Like if you want the system just to show you everything, if I clicked auto, remember again, the cleanest way to do this, and I want you guys to really go to the drawing board. If you want to help design a trading platform, if you come up with a graphical solution, I'm going to make you guys a deal today. If you come up with a graphical solution to getting all of our indicators on a chart in one cohesive system for alerts, education, auto. So what auto would do, right, is that when you have that alert, auto will split your chart for you and then bring up the other chart. And that other chart will have that indicator with that alert that references back to here. So the quickest onboarding and use of all 14 of our indicators in one cohesive system, you will be awarded the rare prize of the inner circle in here called Club Rocket, a free lifetime membership. We will pick one person's ideas, and if 2 of them are chosen, we'll give out 2 for free. How do you make red lines without tick data? We're about to make them for you on the Rocket Scooter platform, or you can estimate using 1-minute candles as best as you can. You just look for those pivots that way. So again, if you have an idea, get out Microsoft Paint and draw a mock-up. That's what we want to see. A layout mock-up of what we can call educational mode. And you can say like mouse over or click, how should it look? And if you do auto, which is something that will just, when the alert happens, it'll bring front and center what you see. An example is when resilience is at 0 and jumping around, because one of the major stocks is at half gap and jumping around like an apple, the alert will tell you what stock is the next one that's going to tilt the S&P over. See, Apple is the one that's right at a half gap. So it'll give you that alert, and auto mode would pop that thing up there for you. It will automatically split your charts and add things that you need to see, or maybe open a smaller chart. Whatever the look, feel, and experience is, the idea is to quicken. See, it's not, when you learn technical analysis, there's infinity indicators. Ours, there's 14. And each one of them is like yes, no, yes, no, yes, no. It's not a lot. They're just all different pivots. And when you add all the pivots together, it's, you know, it's, if you think about like, you know, physics, you're pushing a block up a hill. You have a friction force, a normal force, a gravitational force. You have wind resistance. You know, have all the forces, but you add them all up in the same direction. And the answer to the question is up or down. Does the box go up or down? So the same concept is here. It's like, if you look at it, maybe the arrows could be drawn different distances, different weights for their priority. Example, and I want you guys to help me figure it out. Draw the mock-up, put it in Because we're mocking it up right now as we go, but we want to see what you guys think. If this, because if I rank something on the list, for instance, 12 is like that. 13 or 12 is like that. 1 is like that. And this is the list of all the indicators, you know, like catalyst, you know, red line, hedge pressure. So hedge pressure being a smaller line. Because there's more volume expected with half gap, that could be a thicker line. A catalyst happens. It's the highest one. Maybe it's a thicker line to show the severity of the amount of volume that'll come with it. Size of the line, distance of the line's blinking, flashing, different color. How can we represent? These are the things we want to solve. Number 1. Okay, and I want you guys to help me out. And again, this is what I love about Rocket Scooter, because you guys are designing your own trading platform with us. Whatever problems you had before, how do we make it easy? How can you learn all these technical indicators at once? It's very hard. Okay, resilience is still less than 0. I'm still expecting this to not support until it goes above 0. NVIDIA is killing it today. Let's pull that front and center. I'll teach you guys how to use the scanner and everything else. The two problems that we want to face, the two problems we want to solve here is how to onboard people very quick, how to teach somebody an entirely new concept that typically says you don't need technicals anymore. So either A, we have to our goals are this. Number 1, you're either replacing, and I want you to solve all these problems with us. You're replacing TA or enhancing. And typically for most people, it's going to be the enhancement. Okay, so don't think that everybody's going to come in here with just clean charts. We're going to come in with technical analysis. So we don't want to clutter up their already cluttered charts with more clutter. So because you're enhancing, there's already indicators on the chart, right? Absolutely enhances TA, right? So instead of replacing, enhances. So one of the challenges is everyone's going to already have indicators. All right, we're going to put the challenges off to the side. So we can't clutter it too bad. How do we get a layer of our stuff on top of layer of someone else's? Do we use fewer indicators to enhance the technical analysis? Do we let people have a list over here that they can check off what they want or don't want in one indicator suite? How do we do it? Number 2 is how do we draw all 14 and then plus, in case we make more, indicators on our chart where it doesn't look like a Star Wars laser battle in space. And a clean way to draw arrows for support and resistance for buyers and sellers. Do we draw different weights to show volume? And I'll let the best design or the best 2 designs that we blend be a free lifetime membership and induction to Club Rocket. Club Rocket is our inner circle. Our product steward, our VP of projects, our COO, all came from Club Rocket. They all have jobs here now, real jobs. Quitting their other jobs to build a trading platform. Club Rocket is my most trusted circle of people that when we need something, we ask you. People that have gotten to Club Rocket are there because they made something for the group. It's an honorary title. They helped us solve an equation. They were on one of the teams that helped us put something together. And we'd love to induct 2 more people in that circle. And that if you wanted a career path in the trading and you wanted to do something like moderate, lead, be a VP, be a designer, be whatever, this is the way to do it. You show that you make something that we can use and we'll go for it. So how do we get our indicators on the chart that says this is volume? Okay. to show very simply where resistances and supports are. The next thing is how do we show, and again, how to get the indicators and not look cluttered. Examples, and you guys just pay attention. Do we draw arrows along the borders at 9:30? Do we have the candles flash a certain way? Do we draw arrows above and below? Do we have arrows? Do they match the color of the indicator itself? As the user chooses the color, then that will choose the color that's the same. Do we sum up all of the indicators based on weight? An example, if you have indicators 1, 2, 3, 4, that the weight is, 1 is the highest volume, so it has a higher score. Let's say a score of 1 to 10. So you'll have 1 multiplied by 10, 2 multiplied by 9, 3 multiplied by 8, 4 multiplied by 7. And if it's up, it's positive 1. If the signal is down, it's negative 1, negative 1, positive 1. Do we take all our competing signals? It actually adds up to 0. But if you rank them all up, would that show it's a neutral market? When we have an indicator that adds all of ours up subjectively, or even empirically based on amount of average volume over time, and we just give all our indicators a score and just put the score at the top. The score, it just says, it's slightly positive. So maybe we only show the positive ones. You can show just the negative ones. I mean, any way I'm just flowing here off of the energy drink I chugged. Right, 0. Whoever's texting me, I'll just let you know. When you go out there and you start talking about risk management and you start telling people to ask their favorite trade room gurus to post broker statements, you start losing friends. But like I said, I'm not in the business to not teach what I believe in. People don't like that. That's questionable on their ethics. So, what's the pay like for a designer? Where do you live? Are you in the States or are you in another country? I can give you the kind of going rate for a designer. If you're at a disadvantage, you know nothing about TA, you're actually not a disadvantage. You are perfectly where you need to be. We would like for people to not know anything about TA until they understand volume pivots first, and then TA you can add on top of it. TA is a hard concept for you to understand out the door. It's really hard to use. Seattle, like a web designer, or graphic designer. What kind of designer are you? UX visual designer. In the States, you guys charge a lot. Depends on your competency. The developers, $100 to $200 an hour, typically at the firm. Designers, somewhere in there as well. So how do we draw the indicators not cluttered? Last one, and we're getting some calls. Again, right now, resilience is less than 0. I don't expect the market to rally from here. We're still fighting this fight. It's going to take all day to do something. Again, I'm not pulling the trigger yet on anything. 3 is education mode. To have the platform train you on the fly non-linearly. So if you go to the website, right, education, we try to design a program that you follow linearly, right? But what if the first day you come to the trading session and it's an irrational market with a hedge pressure break, and that's video 15. You didn't get there yet. You're not prepared. So educational mode is some kind of series of alerts. And the goal is to interrupt your education on the fly education. So if video 12 is what's happening today, it will alert you, maybe on the platform, maybe on the website, maybe both, let's just put something here. BBB is, maybe it could be video 10, but alerts need to say, you need to learn this now. Is it going to be a giant exclamation point on the screen? Something that you didn't know what's going on, an exclamation point. Education mode would be you mouse over like a question mark, or you just have a button here that you turn on, education. And education would be essentially showing you what's interactive. You would mouse over, or I guess tap on mobile. Never think of mobile too. And no trades, market's still irrational. And if you had a bunch of arrows, mousing over them would bring up a pop-up, or an alert, mousing over bring up a pop-up, and the alert would basically tell you right here something that you need to know. Watch video. Hurry. It's only 5 minutes long. Watch video now. This is what's happening. And then of course at the educational mode, you can have auto mode, auto education, that will watch video now. If that alert happens, it will guide your platform into showing you what's going on. Maybe it brings up the other thing. It just makes that chart blank, and it shows you some chevrons maybe on both sides that this is what's happening on that chart. It's hitting that key level, and then I can click the chevron and it jumps back in time to, you know, 2020, so the next time it happened, jump back, maybe go to January, the next time it happened. So you can cycle through instances of that thing that alerted in the past, and you can see examples by just clicking a giant chevron that pops up on the screen. And auto educational would click it, goes to the left to the last instance, and you can study, watch video now. You know, auto has found 12 times this has happened over the last year. Click it. You can look at 11, 10, 9, 8, etc. And just go back in time. Unclick that educational mode and you zoom back on your chart. So an example is something's happening. You're like, oh crap. What do I do? Yeah, ideally that you can just click a button and it goes to the last time and you can quickly study that chart. That's what we're building right now for Trade Planner. And that's what we want you guys to know. So the layout is what's important. Educational mode, Trade Planner, getting all of our indicators in, piling them on top of technical analysis, and graphically making it look awesome. Chances are, if you do the design I like you, I will be offering you a job. Full-time job by the end of the year. Past examples. So the goal is to train people on the fly as things come up. You understand that? You have a legion of loyal followers, Matt, that are upset about what you said. Aren't people of integrity over time? I'll tell you what happens over time is the trade rooms are like fashion statements, right? If they're not any good, over time everybody will know about it. And just enough people start saying they suck, and then they just fall from the wayside. Trade rooms had a surge in volume, right, over the course of COVID, and right now when bear markets are down, all these newbies to the business who just started trade rooms this year don't understand the mechanics of the business, and that their sales go down in this time. You'll be a little antsier in bear markets because people don't like to buy trading products. So over time, when markets are down, people just stop trading in general, right? So a lot of times you'll see that just trade room folks out there, I mean, it's not a problem to be in a trade room, but y'all have to protect yourself against paper traders who are saying they're really trading. And that's the whole speech. If I get backlash for that, you can go fuck yourself. I swear to God. That's not cool. Everyone should be willingly able to, and this is talking about nobody in particular, just in general. You'll see a lot of people bickering during bear markets. It's just a common thing. You'll be hyper competitive with a couple of people that are still hanging around. So It's to say you guys have the right. The reason the speech came up was that there was, I can't remember the name of it. I'm not gonna, I do, now I remember it. There's a group that got busted for like a $300 million fraud. It was a trading institution. It was like a multi-level marketing thing. They basically were training people how to trade, but really they were training people how to be trainers, MLM kind of stuff. And like the rumors where they would bring you in the back room and like you would go to the place and they would like hypnotize you, or they would bully you. They wouldn't give you anything digital. They'd show you, print out a piece of paper that you couldn't take away. They're like, these are our results. And they wouldn't let you take it. You could take a photo of it. They take your phone before you go in, and they would push you until you'd sign up. They were very aggressive and things like that. They got a lot of trouble, but that's because people let that happen and didn't feel like they had any power. And the whole reason for that speech was because the gurus of the world are very good at talking. They're very good at influencing you and convincing you that it's not okay to ask questions. And that's a big problem with me, because you have the right as a trader, as an investor, to protect your money in any way, shape, or form. Then the examples are like song and dance of like, hey, guess what? Can you show me your broker statement? No, man, that's invading my privacy. How dare you ask me? You're like, oh, I'm right. Yeah, I probably shouldn't ask him. That's invading his privacy. No! Don't let him convince you against what you want to do. It's your money to spend. But the song and dance is always an excuse to say no. So if they have an excuse to not show you they're really trading, or my account number is on the screen. There's your proof. I'm losing real money if I show. I see me crying. You really don't let people bully you out of the information you want. And if they do, don't pay for it. And that was the whole point of that speech. The traders are easily guided and easily manipulated into decisions they wouldn't have otherwise made, following someone's trades, letting someone convince you it's not okay to ask for proof. Come on, man, that's my privacy. Oh man, my tax guy, my lawyer says I shouldn't do this. Or dude, there's like a script. They all say the same shit. You have to just go out there and challenge yourself. And it's not a jab at anybody out there. It's like, hey man, I got a trade room, chill out. It's like, that's the way it should be. You have the power to ask and vet anything, and there's no such thing as invasion of privacy, and there's no law. One of the times people say it's against the law for me to show my results. Somebody will say it's against the law for me to show you my statements, or my broker doesn't let me, or my lawyer doesn't let me, or whatever. No, it's a lie. Not against the law to show your broker statements. They're yours to show. The way's lawyer. As a matter of fact, if you want to grow a trade room, you know the fastest way to do it is to show your fucking trades. People will fly to your room and want to see how you do what you do. The best business model out there is to show a statement. People will flock to you in droves. Wonder how you're so successful. In past examples, how do we go through them? Like a giant chevron pops up on the screen. Like I said, I don't go out there and make any particular beef with anybody. I'm a big fan of a lot of trade rooms out there. But my education is with you guys. As a risk management, as a trader that's been through the trenches, gone in, come out, the things I've learned are valuable wisdom, and it's wise to impart that so the mistakes that I made weren't repeated. I was in a trade room, not really in it, but when I first got started, I joined a community formed by the Wall Street Bets peeps. It was a Slack trade room. I didn't even know what it was because I never heard of trade rooms before. It's like 2015, maybe 20, I don't know, somewhere in there, 2014. And it turned out to be, and it wasn't Wall Street Bets sanctioned, but that's where I heard about it on Wall Street Bets. So it turned out to be just kids paper trading, the group. And that, again, had nothing to do with Wall Street Bets, but that's where I heard about it. Somebody was posting about it, I joined it. It just happened. I was like, oh man, people are tricking me and lying and leading people. I wasn't trading penny stocks either. I actually met some of the original folks in our group in that room. But it's just dangerous, right? And it's like, I didn't know any better. And now I can teach you guys what I learned. Yeah, don't let people gaslight you. It's your right to ask, and if they say no, it's your risk decision to make. You can still buy their product or not buy their product. Okay, past examples. Click a button, go back in history. Last thing is Trade Planner. How do we incorporate all that into Trade Planner? We're on Trade Planner. Does it show a different thing? So maybe we can have buttons up here, Trade Planner, Auto Mode, Education. So I click Trade Planner. What it does is it'll show me like it's a bull long up with an arrow. I can put my stops here. And I can click these boxes and move them around, type in numbers, and Trade Planner will tell me risk to reward ratio. It's tied in my brokerage account, so it knows how much I can trade, how much risk I'm going to take on my account, things like that. And then it'll show me that all the same, again, we've already talked about this one, but on the same volatility conditions, of the same 5 irrationality checks. Remember, watch the video. We have 1, 2, 3, 4, 5. It's say under the same conditions, check, 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 that your BRLU went from here to here 68% of the time without a catalyst over the last 50 years. And here's 40 examples of it. And again, click the arrow to go back and see the other examples. So historically, you can see the trade plan that you want, past examples of that happening in past by just clicking a button, it goes to it, click a button, it goes to it, click a reset button, you jump to the middle. So I'm like, ooh, I want to short from here to here. So I can click, draw an arrow like that, and click Trade Planner, and Trade Planner will go, boom, 13%, only found 2 examples. And you're like, okay, maybe not that one. That makes sense? So you guys, like I said, I'm handing out 2 lifetime memberships and an induction into Club Rocket, which is our inner circle. You're gonna be part of the crew. It could be a job for you in the future if you graphically create something that's magnificent on all 5 of these points. 5 different things, 1 different thing, I don't care. Your ideas are good as gold to me. I'll even pay you a bonus, cash bonus, for your design. If we use any of it, I'll also give you a bonus. Okay, S&P, let's get right back in front of it. Back to wrong scooter. Okay, we're still irrational outside of the doomsday band. We're trying to break into the rational side of the market. NASDAQ also losing. VIX has rejected that triple B very heavily, which is great for the month. I like that. The S&P is trying to break through half gap and it's having a hard time doing so. The volume that came through is in decay. When volume is in decay, it's anchoring on this side. So we're still stuck in here. So either stocks need to rally and this goes above 0 and we're filling the gap, or something. Nothing yet. Remember, irrational market set out for the day. We're going to learn stuff, and market's gone nowhere. Nowhere. The whole point is having control. Appreciate the guys at the Trading Ant Podcast. Like I said, I've always been an advocate for transparency and things like that. Just seeing if a lot of people are confused. Ooh, Alejandro made a trade. Nice. I go like look at Twitter every once in a while and just see who's long, who's short. You'll see some people. I saw some people said short, some people said long. Oh, what's up? I love King Tendies. He's an awesome dude. Doc's one of my favorite people out there. My brother. We have a cool story of how we met. Are you Tendies? Are you in here today? Hilarious story. So again, I'm waiting for a clear signal before I strike. I tend to just talk and teach while we're waiting. So that no clear signal yet. Been a member of King Capital for a while. I'm very curious about your product. Great job on the product. Thank you, Chris. And what you'll notice is that if you've been tuning in for a little bit, the idea that we can predict the market's unpredictable is very powerful, and I can choose to sit out. And in the meantime, we can use that information to allow us to use this time wisely, right, in the morning. The systems are cherry-picked usually. Trade room gurus buy a stock that tells you when this happens to buy that stock. It goes up, but 20 other stocks promoted, the exact setup and failed. Yeah, I mean, we talked about this yesterday. The math of averages. A 10-period moving average is going to look at 10 points in the past. So price was here at the close, 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 right? And this candle is moving up and down. Your moving average is like this. This tail is moving up and down as this is moving up and down. So say that this candle turns green, and therefore I'm going to change the color and show you that at this point in time, your moving average anchored right there, okay? But for the next, since it's a 10 period, for the next 9 bars in the future, this point actually will move because it's an average of the last 10 points. So while your moving averages may have crossed over here at that point in time, if the candle drops to like 3 or 4 bars and then rallies for 2 bars like that, you got some signals here that didn't work. And of course, this being lower, uncross those, and then eventually they crossed here down the road. So when they show you the picture at the end of the day, it'll show this is where it actually crossed over, but you're really getting the signals right here during this candle. Cross, uncross, cross, uncross, cross, uncross, ding, 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 buy, sell, buy, sell, buy, sell. And it only looks good when you look at the candles and the averages from way into the future in real time. When you get that signal, you can do it yourself. I mean, watch when any 2 lines you have on a real-time ticking chart are going to cross over. Same thing happens. They'll cross, they'll uncross, they'll cross, they'll uncross, they'll cross, as that one candle is fighting right there. And all of a sudden they uncross at that moment in time. Then the market tanked. And then as it's tanking, you'll start to notice in the future that this line is going to start to curve a little more the more it's tanking. And all of a sudden, where it didn't cross, it crossed some point in the past. You see what I'm saying? So it's really hard. It's an after-the-fact art form. And that's the point. It does look promising if we hold today and we hold tomorrow without finding lower lows. Squeeze starts. Let me take a look at my positions really quick. That's what we're waiting for, is that resilience move right here.
Listen to ASMR sounds with your screen off and relax uninterrupted. Try YouTube Premium on us.
Just waiting. You guys ready? Market's rallying till the end of the year. That's my call. Let me show you how I know. Okay, number one. Maybe not from here. If I get the bottom call wrong, I get the bottom call wrong. But after we pass through some major earnings, I really do believe that the market rallies through the rest of the year. And it takes the beginning of the year to sell off. This is a very important data point to the thesis that I developed, in that over the last 2 years, as we've been in this, or I guess from July of 21 until now, when we started trading off of QT rumors and announcements, that anytime the initial jobless claims are on an upward path of ticking higher in general, that the FOMC will start to reconsider a hawkish policy of aggressive rate hikes. As my thesis when I said I call in the bottom on Twitter. Not the bottom for the year. The market likely, I'll say what I said. Back in July, I had a tweet that I made that said there's a 2-month bear market rally, yada yada. It's gonna last for 2 months, this and that. And we had literally exactly that. I tweeted before it happens. I made the trades, showed the trades. It was a big windfall and everybody was happy. And the market was good. Not everyone here, but like everyone in general was happy. Market was rallying, but then it turned around. I waited. And now I said, this is the bottom. The market's very liquid. And there's just 2 parts of the thesis that are very important to talk about. All that matters in bear markets is Wall Street is looking for the Fed to cut rates, or at least not raise them so aggressively. That was exactly what Powell said yesterday in a speech. And recalled that, remember? Swing trading as well, Nate. 100% swing trading. I demonstrate a principle called monthly map. And if you want to give me one of your favorite tickers, Nate, a couple of you guys, if you haven't, actually do me a favor, you haven't checked out Rocket Scooter just yet. Give me your favorite ticker and I'll do a little swing trading monthly map for you and we'll teach you how to do it. But usually what we do is we stream for an hour. We get off the stream, we go to Zoom. So everybody go to Discord right now. I'm going to post a Zoom link very quickly. And in that Zoom link, I'm going to give you... we're going to go through more of an educational session today. And I usually show more of my detailed teaching in the Zoom. This is usually just showcasing my trades, but we're not doing anything today, so nothing really to talk about. But we're going to go to Zoom in about 30 minutes, and in the Zoom call, I'm going to go through and, again, if trades pop up, I'll take them. It's for members only. As a free trial, you have access to that Zoom call for a week as well. It's a lot more detailed. We stream to the public for about an hour, and then the Zoom, you guys come in, and then we'll Zoom with you guys. A couple hours. All we want to see is the Fed to not cut rates so aggressively. That's so shorts can cover, taking their props for the year. So we're looking for signs of Powell being less hawkish. Okay, I'm going to actually retweet this. In the press conference, right? I he nailed it. Okay, that's exactly right. What we said was what happened, right? We build a fundamental thesis and then I trade the numbers around it. Don't listen to fundamentalists who don't understand trading. Sky is falling. Yes, but it doesn't fall. It's really just gliding. It's gliding lower. If it's going to fall, it's probably going to fall early in the year, even in the summer, I think. That's just what I think. All that matters is that Wall Street's looking for the Fed to cut rates or at least not raise them so aggressively. So looking for signs of Powell being less hawkish. His goal, QT without creating a threat to the labor market and plunging us into stagflation. It's a very simple thesis. Stagflation is unemployment and inflation at the same time. Crashing stock market will be a massive wave of layoffs and a massive bailout required to kickstart. Basically, financial nuclear winter. Much more risk for the Fed during that environment than providing liquidity now. They're not going to sell off at the top to plunge us into death where they have to rescue us at hundreds of times the risk. Obviously, we are selling again because resilience is less than zero. I didn't expect it to break through that, just like we said. And I'm again sitting flat and doing nothing. Beautiful. A lot of people buying the dip, chasing the high. Market's gone nowhere. And as I said, it's going nowhere. Resilience less than zero. This is resistance. Do you see how awesome that is? I want you guys to check it out, the platform. Sign up for it. And again, play with it for a whole week. You won't be disappointed in the forecastability of these indicators. Resilience when less than zero. It is a leading indicator, can lead for hours. Resilience when less than zero at exactly, I'll show you, this point in time. Like 9:50. Literally here, all day long, I know that this is resistance. As it's rallying, 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 rallying. You see the people here in chat saying it's resistance, nothing's happening. Isn't that neat? I'm just sitting here confidently talking. You may think I'm not watching the market. I'm just you're witnessing somebody in complete control of their trading. The market's not telling me what to do. I'm ahead of the market. Do y'all notice the difference? Nate and some of the other folks that are new here, Abe, Chris, you notice that this whole stream you can watch, I've been ahead of the market all four of these pivots. The open, the bottom off of triple B, the top off of half gap, and then the rejection of the UVXY call wall, and then the rejection of a half gap. All four of this, I've been ahead of it, right? And so I'm just calling it left and right because there's no catalyst and reason for the market to move. And it's irrational and outside the band anyways, so it's a lot riskier to even do anything down here anyways. A lot of people are trying to figure out what to do, and I am just sitting here like waiting for what I want to see. You're witnessing complete control. The market is not telling me what to do. I'm waiting for the market to do exactly what I want it to do before I take a trade. Going forward, bad news is good news, and I was saying that for months. For the first time, unemployment filings, this is why I called the July bottom and 2-month rally. Only 2 months though. We needed a real press of liquidity and a real mixed quarterly report, mixed bag, to really show that the market's not as bearish as people think. Now, it needs to be less liquid for it to crash. That's exactly right, and liquidity is our specialty. Having trended with the market all year, anytime unemployment filings go up, think about not a bad sign for the economy. People losing their jobs is a bad sign for the company the next quarter or even 2 quarters later, as that becomes something that works its way into that company's earnings or performance. Somebody losing their job next week and next week, the negative effects of that one job's lack of participation on that company's performance won't be seen for a quarter or two. And it's my theory that these people getting laid off are not the efficient workforce that are creating things for that company. These are your bottom 10% as companies are trimming to optimize of a lot of the, we had a bunch of accountants and we let them all work from home, and we really only need one and we have 3. Times are tough. Let 2 of them go. And it's not because they're not good at their job. It's because companies are realizing that in the world of COVID, they've learned how to become more efficient to survive. So I believe that like Tesla's 10% of the workforce being laid off and other people being laid off. Lazy slobs of work. The Netflix from homes. Yeah. But it's not a bad thing. It's just that they have to optimize, and that improvement to the bottom line, bring up some cash flow, is better for companies to optimize and improve. Layoffs are always bullish in the short term. Always bullish in the short term. Immediately bullish in the next quarterlies. Because if the estimate that the earnings per share was going to be X, and the company laid off 10% of the workforce 3 weeks before earnings call, that earnings per share will go up slightly. Well, I guess not for the earnings call, but for the report was filed, not the call. But when that report was filed, so essentially if you lay off a bunch of people, you immediately just expended a whole lot less cash week over week over week for paychecks. That'll, if it's enough, it can work its way into your bottom line, and you will beat the expectation very rapidly. So another thing to note is that when this is ticking up, you have to think the other side of the trade, not, ooh, that is bearish. Yeah, layoffs are bearish. When a company lays off, 20%, 30%, all percent of their workforce because business is bad. Company, or they lay it off because they can't get the raw materials, or they can't make profits, or they're struggling. Companies tend to lay off when they're struggling after the markets crash and after the markets rally. If you remember my story last night, here's 2008, here's 2009, here's 2010. And like the summer of 2010, when the market's recovering, after all of us kids were like, whew, stock market crash, recession, we're good, a year in. The company's like, oh, by the way, we're gonna lay off half the plant right now. At this point, the market rallied forever from there. Literally was like, but the market's rallying. Recession's over. There's bailouts, and they're like, we're trimming half the plant. We went through a merger at the time. Our company was bought by Dow Chemical, and they basically trimmed the plant in half. The original company I worked for was a German company. Now German companies they're badass when it comes to hiring smart people in abundance. They like to have a huge team of smart people because they make shit that works. There's a reason that stereotype is true. German cars are fucking awesome because they hire lots of engineers and spend the money on them to do it. And then Dow was like, no, we're gonna run it half of that. We bought you because you were profitable, but we're gonna trim the workforce because we think we can. So 6 engineers at the plant, 3 of us got let go, and I was the newest guy there, seniority based. The boss was like, go ahead, 3 of you guys go. It's gonna be seniority based, y'all do the math. Well, we can place you in the company, somewhere else, yada yada. But we have no control, right? Dow's calling the shots from here. So anyways, I was really surprised that I was getting laid off as the market was recovering. I'd been there for maybe like 2 years at the time. And so the layoffs is because after the company's shares got beat up, the shareholders here are like, well, what are you gonna do about my shares that are depleted? What about here? And this mode is not when people are exhausting of their patience. The crash takes place in the course of 1 to 2 quarters, and it's here when the pressure starts, and it's here where the pressure grows, and it's here when the company takes action. Shareholders are loud, very loud, and the company's like, fine, shut the fuck up. Let people go. Your shares are gonna go up in value. And that's why they do that, because when you lay people off after the bottom, you're on slow roll anyways, you immediately improve your bottom line, and stock market continues to recover. That's what layoffs do. They improve your share value after the recession. During the recession, laying people off is a sign of worse things to come, but at least in the short term is certainly bullish because it'll be reflected immediately in your quarterlies when bad economic data slowly works its way in 1 or 2 quarters out, which is why my call is saying that the recession continues or crashes in the summer of next year. The market's too liquid to fall, and we're not really seeing massive waves of layoffs. We're seeing seasonal unemployment and a trend that says if you were betting on the Fed going from 50 to 75 to 100 to 150 basis points every single rate hike, then as a short, you want to see that hawkishness improve and get more hawkish. And if you've been short and you finally made your money all year, especially if you were short during COVID, like you shorted at the top and market squeezed a little bit, and now you're finally in the money, the very high probability you're going to see shorts lock in those profits right now just for the tax. You think say they made that money, right? They got the short they wanted, and now it becomes a puzzle of liquidity. So if unemployment filings are going up, then a short would say, ooh, Powell's going to be less aggressive raising rates, because if he raises them too fast, companies might start trimming faster and laying off, and then we can create an illiquid situation that crashes the stock market, which nukes the labor market, and then we have stagflation. He's got to bail us out later. Doesn't want to do it. So as a short, I'm thinking like a short hedge fund as markets rally. As markets are selling off and unemployment goes up. As a short, this would scare me, because I'm not thinking that, ooh, unemployment's going up, my short's going to crash tomorrow. Shorts take a long time to play out, and usually you have to buy calls to hedge them, which means you pay collateral for swaps or premium for calls every month to hedge your short. You got to hold on to a short and type a lot of money for long periods of time. Ask Michael Burry, same thing happened. Usually when your short plays out, you're ready to cover. People love to long the market for years at a time. People don't like to short the market for years at a time. It's not a common thing. Shorts don't pay out as much. They're rarer. Markets tend to be mostly bullish and bearish at all times. When people go really short, they tend to abandon half of their position literally within 2 months later. Like the shorts abandon most of their position. People that are aggressively shorting within a month covered what took them a quarter to build. People will short and get out really fast because it's very expensive to hold a short. So back to the thesis, is that a short trader getting signs that what's propelling the bear market, which is simply the Fed alone. The problems from COVID are gone. The bottlenecks are gone. Transportation's better. Prices are lower. Inflation's coming down. So no longer is inflation the reason for the Fed acting. The Fed is trying to remove a little risk from the table, but depressuring a little bit at a time. You can just see it in their actions. And they're going to depressure until the market starts to look bad, and they're going to kind of hold. I bet you we get 3 basis points or less starting next FOMC meeting. I bet you next FOMC meeting is going to be 50. It's not going to be 1. It's not going to be 1 until at least next summer, and they can prove that the market hasn't crashed. And if we rally through the year and double top the market, JP is going to come in next year and start putting in 1.5. I could see us getting up to 3 or 4 basis points, 300 or 400 basis points by the end of this cycle. It can be 2 to 5 years of bear market, but this is a liquidity thing where the market is too liquid to crash right now, and I'm betting the farm on the bull market. Okay, I'll talk about my trades in just a little bit. Finish this lesson. So as this is going higher, shorts are scared of Powell's comment that says we're probably going to be less hawkish. If rate hikes are what's crashing the market, every bear market has never reversed, never in the history of what I've looked at, from a bear market of 20% or more into a bull market again, never was triggered until you had rate cuts. So the first step before rate cut is rate hikes plateauing, and then the hike is less. So they go up to 75, down to 50, 50, 50, 50, 50, 100. Then the market's going to follow that path. But if people are fearful that Powell is plateauing, this is a leading indicator that Powell will plateau. And when this happened, I made this call. Powell's exact commentary was exactly that. I don't know if it's still here from yesterday, but the commentary was literally that. We are reconsidering how aggressive we're being. Let's go all the way back to yesterday at the news. Let's go all the way back down. Financial Juice, I love this website. All the way back to yesterday. Does that make sense on that thesis? Are we live? You're live. One more thing. Go all the way back to the meeting. So you finally can say, this is the first time Powell said this, the press conference, if you watch the video from yesterday, is it really moves the market. We believe that the labor market can soften without massive layoffs. And he's right. He's very smart. The labor market is softening, meaning that people are getting laid off without massive layoffs. Because again, What's softening the labor market? Letting go of people that are, we call inefficient labor. 100% right. People that aren't adding to the company's performance just because in a bull market, people tend to hire and expand fast, but in a bear market, you trim the least productive of your workforce. It's not an insult to people that aren't working. It's just that, if your job is R&D and we're about to go through a year of turmoil, they may not need to be spending money on R&D or whatever the course may be. The broader picture remains an overheated labor market. Okay. So cost of labor is high. Therefore, cost of goods that you buy is high because it works its way into the price. So a hot labor market, jobs are in high demand. My programmers are asking for raises or they're going to quit kind of thing. That's how the labor market is right now. Everyone can get paid whatever they want, and inflation's causing people to ask for more. And jobs are so plentiful right now, people can go get the job they want. It's pretty rock solid labor market. And so you want that to bring inflation down. Cost push inflation is repaired by the labor market improving. More people working, more people making stuff. More stuff means more products on the shelves. More products mean more natural competition, which brings prices down. Easy as that. People keep their jobs. Inflation's in check. How raising rates doing nothing for inflation. Not this kind of inflation. It's not the kind of inflation that rate hikes will cure change. If we don't get the inflation down, it will become entrenched. How do they get the inflation down? You might be listening to the talking heads thinking that the rate hikes is doing it. How do they get inflation down? Is they protect the labor market. They protect the labor market. Do we all understand that the control of inflation is keeping people employed? As companies are going to start laying off their inefficient labor, they're going to hit a stasis where there is no need to lay anyone else off. And the company's now beating performance expectations. All they care about, their stock price improving, means they just have to lay off just enough to beat expectations. That's it. That's it. So do you guys believe my thesis? How do they get inflation down? In a hyperactive market, when everyone's got money to spend, everybody's making products, everybody's investing, expanding, people tend to invest in sillier, broader things that are riskier, like crypto and NFTs at the top of a bull market. Those things become palatable when you have so much money and everything's making money. You're going to become stupid with your investments and buy riskier stuff, right? Because of that, the value of everything goes up rapidly. The value of cartoons went up by millions of dollars. Wait, what? That's where that inflation comes from. And the Fed pulls back by raising rates, slaps everyone in the face. Participating banks now have a better way to make money than lending to your risky assets, taking the loan you took out, buying an NFT with it. Banks are like, ooh, I'm gonna park some of my money with the Fed instead and not lend out. Raising rates destimulates lending, which destimulates spending, which gets you back into check and stop buying stupid shit with your money, right? So the way to get inflation down in a hyperactive market, yeah, raise rates and slap everyone in the face. But raising rates right now, banks are already like, we already aren't lending. Interest rates are going up. House prices are double their value because the cost of lumber and the cost of labor to build it was really high. And just a $300,000 house, people are wanting to sell it for $600,000 over the course of a 2-month. No, we're not giving out loans unless you're a AAA borrower. Not easily giving out bank loans, period. Fed raises rates, the banks are like, oh, sweet, free money. We're already not giving out loans. They're put in the Fed. It's not destimulating lending. The high premiums of things that are inflating from cost push inflation is naturally destimulating lending, and which is the high prices are destimulating spending. This inflation is not curable by the Fed at all. Do we understand? How do they get inflation down? Is by preserving the job market, by keeping a surplus of inventories where people are forced to lower prices to unload them. Imagine, car company makes 50, Audi A5s for your car lot. But inflation is making them 40% higher. They were, 40,000 base price. Now they are 56,000. I don't know. fewer people can buy them. The problem is if they don't sell off 50 of them by the end of the year, you got your 2023s bumping right up into it. Things like cars, things like fashion, things like technology, televisions, phones have an expiration date that you can get that first alpha run retail sell of that particular item before it has to go to the secondary market or whatever. You have to sell exactly what you make, you're going to lose money. You have to make exactly what you think you're going to sell, you're going to lose money. What happens at the end of the year, if Atari has a surplus of the ET game from the 80s, about to date how old I am because I'm 41, and nobody wants to buy, they literally took those horrible ET games. There was millions of dollars lost on that game. They had to bury them in a landfill, and then it killed the gaming industry for like 5 years. What happens if inflation's so bad that Audi pumped out 50 A5s to that car lot and every other car lot and people only bought 5 of them, 10 of them? They have to halt production for the next year, or, which means they have to lay people off, or they just keep producing and they push cars out and push cars out and push cars out and nobody can buy them. Companies are probably going to choose the latter path to operate at a loss before they go to laying people off, because they understand that those problems are temporarily fixed. If they flood the market with supply, prices will come down and you will choose to buy them, and banks will choose to lend out despite the Fed raising rates. So companies in this mode are deciding to continue to make stuff and operate at a loss while margins are low, hoping that their surplus and the net effect of everyone else, like, hey, I'm making cars, you're making cars, you're making cars, keep pushing them out there. Let's get prices down, because then overall people will start buying cars again, and banks will start feeling comfortable giving out loans for cars and houses and other big ticket items. So preserving the labor market is the only way to get inflation down at this point. That's it. Turn Matt's live streams in the podcast. The cost of labor is the biggest component of operating expenses, especially services, especially building trading platforms. Had to downgrade from Celsius to the cheap monsters. Daddy's poor. I gotta pay for developers asking for raises. Can't even drink the fancy energy drinks anymore. Blech. Actually, that one's not that bad. There's one called Paradise, is actually pretty good. But the thesis is solid, right? And all he talks about is labor market. We will update our estimate of where rates will need to go in December. It is premature to consider pausing. Again, they're not going to pause the rate hikes. If we do not tighten enough, inflation may become entrenched. Possibly. Debatable, but I don't disagree. Stuck, right? It's possible. I would argue that they don't need to tighten right now anymore. That, I mean, well, I guess tighten, they have the control. Letting those things mature, they're going to come in and make a decision at some point to continue their policy being in the same way. QE is nowhere on the table coming forward, but the market's liquid enough to stave off, I think, anything that the Fed does this year, and next year that'll be the problem. Inflation become entrenched, possibly, right? Oh, what's Trade Brigade? What's up, Maddie? How you doing, dude? It's been a while. You missed the streams? By the way, we need to chat. Send me a message Discord. I got a question I gotta ask you, by the way. Inflation being, I guess, like, entrenched. Think of a trench. You're stuck. Like, think of trench warfare in World War I. QT is causing people to sell the market, right? Because they believe that in rate hikes are causing people to sell the market. Companies tend to lay off after stock market crashes, and that layoff is what's going to entrench the stock market. So to say what he's saying, if we do not tighten enough, we'll become entrenched. So what he's saying is that if we do not tighten enough, markets will crash. That's what's the only thing that's going to cause entrenchment, is unemployment with inflation, called stagflation. That's what that means. So he's saying if they tighten, it can ward off a market crash, which I don't agree with, because Wall Street is reacting to that news and selling off. Now, QT will, in a way, it's like how rate hikes kind of slap people in the face. They stop investing in NFTs and things like that. Quantitative tightening is kind of to bring people in check as well on a more broader scale. The Fed is no longer boosting the economy. The afterburners are turned off. So we're kind of left on our own, but are we doing okay, right? I think so. Tightening is to put the stupidity in check, and you're starting to see the crypto markets and all these other markets respond to QT. The actual truth of what those markets are revealed. Just risky assets that really have no purpose, and the first thing people bail on. So we want to avoid making the mistake of not tightening enough or loosening too soon. I think that they should stay on the same path that they're on, because Wall Street's about to prove to the Fed that we're too liquid to crash. And as long as they're doing that, Powell's going to hold it at 75 basis points. And probably first quarter next year, if we beat earnings this Q4 and beat earnings Q1, he's turned the afterburners on double the speed. I promise you this, I can see between the lines. Powell is holding back, saying that we're going to 200 and 300 basis points by middle or end of next year. It might sound like a lot because you've never seen it before, but allow me to show you something. Watch. That's not really that high when you look at the history of these numbers. You might not have seen that level before. Oops. Again, my thesis is really solid. And again, markets are rational still. I'm watching another screen. Nothing going on. You might be like, holy crap, that's really high. And then you might be like, oh, wait. No, it's not. Okay. We have been in QE for the longest fucking time. The market is due for a reset, but you'll see that week over week at any point in the 2000s, in the 80s, right? You can go all the way back. Look, here's what the 80s were like, a 12% interest rate, 9%. We're sitting at 4 right now. The changes week over week were massive, right? Like way back in the day, you get like you'd get like, you know, every single time. Imagine going from, let me look at this jump right here. Okay. Imagine seeing rate hikes every single time for 5 years. Imagine seeing rate hikes from 1986 until 1989. Imagine 3 years of rate hikes. We're going to probably do something like this. We're going to hit that first wave where the market responds. The most rapid is, oh my God, rate hikes. We get out of the way. This right here, and then we're going to have a period of likely tapering at some point. Now, Powell has said we don't anticipate lowering the rate like a rate cut, but they're going to raise them slower. So what that means is it's this right here. Actually, that's a better way to see it. I'm going to predict that this is what we're going to see, just like that. You have your aggressive rate hikes, right? And then we're going to taper for a little bit. All the FOMC has to do to stimulate liquidity from this point is what? Imagine this, right? Put yourself into the pants of a Wall Street trader. Ooh, that sounds kinky. Imagine this. Imagine we have rate hikes looking like this. And imagine we have a linear, like if we're getting, you know, 50% or 25 points, 50 points, 75 points, 75 points, 75 points, it's a straight line, okay? Imagine if they say 50. And imagine if they say 25. Imagine if they say 0. And we're here at 0. And it's 0. And it's 0. And it's 0. Market is rallying a little bit. it's not getting better, so longs start to sell. So now the stock market looks like this. We rallied, we've wave 1, wave 2, we're down here at the base of wave 3. Fed starts tapering, 2 quarters out, we are like right there. 3 decisions of no rate hikes. People are like, let's go ahead and take some profits right here. At this moment in time, the market looks like it's going to crash. What will the Fed do right here, summer of next year, if the market's crashing and they want to preserve the labor market? What is the one thing the FOMC can do that will turn everybody into town, into a bull, in a heartbeat? If they stabilize the rate hikes by tapering off how aggressively they are, which is commentary says they are going to consider in the next meeting, we're initiating a tapering process, which means we might go from 75 to 50 to 25 and then no change. We might sit at like 5 to 6% total rate and go nowhere. And then people start taking profits and the market gets very illiquid and it's now challenging a potential crash, right? A market crash will completely decimate the labor market. Unemployment at the base of the crash will be here and unemployment will completely take over and we will stagnate and entrench that inflation and never get out of it until they bail us. So if the market's about to crash and the Fed gets the warning sign, there's one thing they can do in a heartbeat that will rally that market. What is it they can do? Wall Street is just listening to the numbers on the surface. My buddy SoFlo always calls it the Homer Simpson number. It's the number that you tell the average idiot that goes, well, I guess I'm gonna buy pumpkins in October because they're going up. QE, or a single rate cut. 0.25 cut. One announcement of a rate cut will turn a market crash into a squeeze like you've never heard one before. And all they've done is they've driven the market, pressure, market's looking scary, and then it's gonna crash. Okay, no, guys, a rate cut. One announcement of a rate cut, you won't see a single bear in town. Will you? It's like you have a balloon, right? And you have, here, I'm going to draw something. I'm really horrible at drawing. I'd understand if you canceled your membership. This drawing is horrible. This is supposed to be a pump. And there's a dude right here with his hand on the pump. And there's a tube going into this balloon. And when the balloon gets close to the wall, it's expanding, the balloon's about to pop. They're coming in and letting out some of the air to depressurize it a little bit. We get comfortable again, then they pump it up again. A single rate cut is enough to rally the market and flip everyone bullish because everybody knows that narrative. Rate cuts in a bear market. One cut is all we need for quarters of rallying. One cut and then hold it flat. And once the market gets stable again, they turn on the afterburners for round 2. And that's summer of next year when liquidity is out of the hands of the banks. And we've seen that here. We're going to have exactly, I believe this. I believe this more than I believe in, I don't believe in a lot of things. I believe this wholeheartedly. Look at this. We even tapered and we cut. I like that. Okay. So we're entering the period of slowing down right here. And all it takes is a rate cut or two to create a bull market. If they say rate cut or hint at rate cut, they don't even have to wait till the decision. We're going to hint, if they could stop a sell-off like that by saying, we're planning on cutting rates. Everyone's a bull at that moment in time. Every short gets squeezed. And they don't even have to cut the rates. They need to say they need to do it. This is where we're going. And I'm going to post thesis number 2. Oops. Exactly what we're looking for. I'm going to save that for later. Okay. So you might not have looked that far into the past. Looking at what we have now, it may seem bad, it may seem aggressive, but it's not really that bad. It's pretty normal. And if we taper off 4.5, 5, 5.25, 5, and we sit at 5 for about half a year, one rate cut will turn the market bullish, and then they're going to be aggressive at the top of the market again. If you ever get comfortable, bulls are going to be like, yeah, they're cutting rates. And you and I are going to know it takes a long time for them to achieve that goal of theirs, right? It's going to come in stages. Res is starting to push above zero. We're about to get into rational territory, you guys. Okay. Last part of the thesis. Again, I think of these things months out, and then I bet on them. This is on the short term. I didn't tell you guys why I called this bottom. I made two really massive plays, and then this time around, I'm teaching people how I did it. Our members know why I did it here. The public didn't. We didn't tell anybody. Back here, I didn't even tell the members. I built my thesis. I made the trade. I go, aha, that's the trade. And the next time I came around, I made the post, and everyone in here was on that same page. And then now I taught the public. I have one idea right now that I've told nobody yet. Another idea. Again, once it plays out, I'll tell you how it worked, and I'll tell you the next time it's going to happen. I like to secure the bag first and then teach you how it works so that the next time it happens, we'll talk. This next idea, I might even be generous. You'll help us build the community, help us build out Rocket Scooter, get the word out. I'll tell you when the bear market's going to collapse. I'm going to be the biggest bear in town at the right point in time. I'm not going to tell you when or where or why or the thesis I have, but it's already established. This hints at it. Okay. I'll be the biggest bear in town come summer of next year. Market will be extremely comfortable. I know that the Fed is going to turn on the afterburners one more time the minute the market's comfortable. People are so new to trading, they think 5% interest rate is huge. It's pretty nominal relative to what we've seen before. Watch out, resilience numbers, guys, are popping to rational territory. Keep an eyeball. That SPY there. The last couple data points of the commitment of traders shows 3 periods of high liquidity in S&P futures even during the bear market. Liquid markets don't crash, not yet in the history of this report, until the red line dealers themselves are short. Enjoy the relief rally. The last thing is the market is extremely liquid. You have shorts covering, longs selling at the time, which is people exiting the market. But when you get to the COT report, which is a futures thing, and this again one of our tricks, what you'll see is a very cool trend. You're getting your first mortgage is low 10%. Are you old like me, Alan? Are we dating? Are we dating ourselves when I'm talking about ET and Atari? Are you a 80s kid? Older? Ah, yes. So you remember buying a house in the 80s then? I was born in 81. I just turned 41. Can you believe that? Don't let the Botox fool you. I'm certainly old as fuck. Apple II gen? Bro, I had an Apple II in middle school. I learned how to program BASIC on my Apple II. 41 gang. What's up? How all right. Where are my grandpas in here age 40 and older? I'm gonna consider myself a grandpa at this age. Let's get some. Who are my grandpas in here? And who are the kids? 25 and older. 25 and younger. 47. Man, you old buckers. Don't we look good though for 40? I feel like 40 is like the new 20. I feel like I look the best I've ever looked in my life. I'm gonna tell you, when I shaved my beard to be Forrest Gump for Halloween, I was afraid my girlfriend was gonna dump me. I looked hideous. I actually looked like really old without a beard. I looked weird. It's growing back, thank God. She looked at me today and she's like, I'm not gonna dump you anymore. I was like, oh, thank God. Alan 58, do you win? Yes, you do. But 40 and 50, I feel like are people's real golden. Like I feel like I'm the most energetic. I'm the most in shape. I feel like I look the best. I mean, I never really looked that great to begin with. I kind of like hit like ugly all the time. Ugh. But I feel like, you know, like I feel like this is. I benched the most I've ever benched before in my life. I feel great. And I have high blood pressure, you know, like old people problems now. I have really high blood pressure. When I did my blood pressure at a Walgreens, the numbers didn't flash. Instead, a picture of an ambulance showed up and was like, we're calling the hospital for you. You're currently in a hypertensive crisis, stage 3 hypertension. Nicole sent a picture of it to her cousin's girlfriend who's a nurse, and she's like, take Matt to the hospital now. And she's like, well, let me do the machine to make sure it's not a mistake. And she put her thing in, it wasn't a mistake. I put my thing in, it came in fucking higher. So then I basically was freaking out and having a panic attack, and I went to Chick-fil-A and got a milkshake, and I slept it off. But I'm gonna tell you, you guys are killing me. I'm gonna die. Stop drinking Monster. Listen, MK. Your intelligence and wisdom is not welcome here. I did not ask for your logic or your perfect, irrefutable point that you just made. How dare you? How dare you come in here with your logic and your smarts? Get the fuck out of here. Stop drinking Monster. I should stop drinking energy drinks though. That's definitely what's doing it. Okay, finishing this up right here. When these guys are tapering, all right, this is a really cool thing. We have videos on this, but I'm gonna go through quick. Asset manager leverage funds. Green is the people buying the market, blue is the people shorting the market. Get out of here, Walmart Black Friday deals ad. Okay. When blue and green are doing this or that, market's liquid. That is more liquid than that. Markets are doing that. Longs are adding to their longs, shorts are adding to their shorts. People are adding money to the table to trade. When markets are doing that, longs are selling, shorts are covering, they're exiting, but still liquid. Buyers and sellers find each other like that. Buyers and sellers trade against each other like that. Entering trade, exiting trade. Less liquid than this, but both liquid. Pulling, pinching, pulling. Liquid, liquid, liquid. Liquid markets do not crash. Number two, when they're parallel, everyone's selling and shorting together. Markets illiquid. Illiquid markets rapidly trade lower. In the period that everybody's selling, like people are shorting, people are selling. The market makers are now on a spree of going long when everyone's selling to them. Easy as that. Red is market maker. Market makers are holding the bag. Not once in the history of this report has the market ever crashed while the dealers are non-net negative. Never once. Resilience to the upside. Let's go. Okay, market's rational. Let's get ready to go. This is it. My thesis is very solid on this one fact. Liquid markets don't crash and dealers are holding the bag. They will not let the market fall until they themselves are short. Go watch The Big Short if you want to see this in action. The banks did not stop paying off the ratings agencies to rate these diversified shitty mortgage bonds as AAA or like good when they weren't. They paid them off to like re-diversify them, put it at the bottom of the stack, pay them off, and the banks were now short the market, and then they stopped bribing the ratings agencies, and then the housing market collapsed. But it didn't collapse until the banks are themselves short. And that is the rule of Wall Street. And if you've not traded long enough to know that, welcome to the big boys table. Because in the history of this report, when this red line is greater than 0, the market does not sell off until the dealers are negative. It happened here. It happened here. Didn't sell off here. Big market crash, but it had a wave up before it crashed while the dealers unload the bag to you and me. Dealers are positive, market didn't crash. Dealers are positive, market didn't crash. Dealers are positive. Even after COVID, market didn't crash. Dealers are positive, market's not gonna crash. Ain't you a model? What's that TikTok thing that's like? Smile? Raise your eyebrows? Stop smiling. That's how you do your Zoolander. What it is? Smile? Raise your eyebrows? Stop smiling. Right? That's how you do your blue steel. Don't tell people. Like, use it in the bar. I promise. I promise. If it ever works, that person is extremely drunk. It's never gonna work. If it works one time, you marry that person, I promise. Dealers in orange. Anytime this red line is above 0, we have sold and shorted to the dealers in mass. Literally, asset managers have dumped their longs, shorts have entered new shorts. Everybody's sold the market, and dealers have now had to become positive. Banks and market makers are holding all the stocks, all the futures, all the everything right now, because the net sum of all market makers are positive on S&P futures, which reflect the market's risk and positive stocks and positive ETFs, and especially ETNs. This is a reflection of the ETN risk and the risk network of the market makers and ETNs. Because ETNs, they have to trade futures to make the cash to settle the gains or the swap of the ETN, which is a debt instrument, and is a cash settle instrument. So an ETF, they can just hold the shares of the stocks. When they're holding the futures, it means they issued ETNs as market makers. You know what exchange trading is? ETF and ETN, they're very similar. One is a debt instrument, one is a basket of stocks. If I buy an ETN and it goes up in value, some of the VIX instruments are ETNs. They're not out there. You can't buy VIX. Doesn't represent anything. It's a change in the VIX. So if the VIX goes up, they need to find out some way to pay you out if you dump to them. So the ETNs you buy or short, they're over there buying and shorting VIX futures just to settle out that cash settled derivative. And that's how ETNs work. This is mirroring ETN market, which is mirroring the ETF. You have an ETN and ETF that both track the index. They're both going to track the index. So if they're both selling off, this futures distribution is a relative showcase of the market makers' risk, who are the ones that issued those ETNs to you. And it's a futures trader's trick. Now think about it. The longs are dumping. This is the net sum of all of the people classified in this category, asset managers. It's like your 401ks, right? They are becoming less long stocks as a net sum. They're selling the stocks, they're going to cash. Makes a lot of sense. But at some point, cash is inflating, so cash is losing value. And if the market's liquid enough, they're going to start buying because it's better than losing money to inflation. Next thing is when the dealers are holding the bag, when everybody's sold to them and they're now holding all the inventory of everything, and they have power to raise or lower prices, they need to offload that to us. They need to sell to us, which means they need to find buyers. They can find them two ways. They can lower the price and attract new longs, or they can rapidly push, I'm not flipping you guys off, they can rapidly push price up and squeeze out shorts, which also will buy. 1, 2. So when you look at that in this mode, the dealers are now long the market in a recession, and they control the price. Ugh. Right? There's something like, holy shit, we're holding the bag, and we can change the bid and ask price to change the price of the market. We need to find buyers. So I can either lower the price to attract some longs, but it's kind of a recession. That's not really gonna happen. Or, man, look at all these people that are short. We can raise price to squeeze out the shorts. Whichever one of these is the bigger slope the weaker trade. The easiest trade to liquidate. You can either attract buyers. If this is sloping really heavily, they're going to raise, they're going to know that buyers are here at this level. Okay. If this is sloping very rapidly, there's a ton of people betting against them at this level. Who are these shorts short against? Well, if this blue is sloping faster than the screen is sloping up, then the majority of this trade is shorts trading against the banks. So if they lower the price, they're just handing out free money to all these shorts. So if they raise the price, it'll likely attract buyers, as proving so did. Raising the price attracted buyers, raising the price attracted buyers. And there's enough people short against the banks that raising price will squeeze them out. Short squeezes to the end of the year, guys. That's literally all I'm saying. And then we are not going to crash until that's less than zero. And when that's less than zero and Powell raises rates again, you can say goodbye to the stock market. I'll be the biggest bear in town. Mic drop. Let's go. All right, rocket scooter, resilience, now positive. Let's go. Market's rational. Let's go. Now it's time to look for trades. Let's go. All right. My plays, I have December 9th, 310 NASDAQ calls. And we're going to do a monthly map. I have Google, December 9th, 100 calls as well. Let's go ahead and map out Google on a and I'll, you guys here. I'm going to look at what you guys are saying. Feeling old, y'all are so funny. What were y'all saying earlier? About COVID, as Trader Gate said, as soon as jobs went out the window, rates went to zero, market rallied like a bat out of hell. That's it. And the Fed can keep the market crashing by just changing their narrative really quick. So you guys are 41, 47, 40, 45, 53, 43, 55 Angel. Ooh, all right. 41 gang, let's go. Okay. Do a monthly map using Rocket Scooter. I'm gonna bring up the classic app. So my thesis is really strong. My thesis is not calling a bottom, in case people are like, well, everyone called a bottom. I said, no, actually my thesis is calling a bottom before it happened, saying that it's going to rally through the year, saying it's going to be a couple weeks of selling at the end of the year. And then beginning of January, it's going to rally, rally, rally. Fed's going to taper off raising rates, probably rate cut after maybe 3 or 4 cycles of no changes, a rate cut to protect the market from selling off. And then when QT's fully realized in the summer, the Fed's going to try out to burn his markets and crash. That's actually what I called. I didn't call a bottom. I called a bottom in the next 8 steps. So that's how I try to play the game, and I try to see something people don't see. Now that I have a thesis, like I said in the podcast, now we're gonna look at the numbers. Let's do Google, right? Now, monthly map is something that we are currently making automated. So what I can do is I can go to the old app or the Rocket Scooter app. So classic app's like a smaller condensed version. I can do it on this side. That makes it make it pretty easy. I can type in any single date I want and hit refresh. It will show me where the market is split. Now I compare one day to the next. So let's look at how the map has changed from one day to the next. This is for Friday's expiration. There's a massive, massive, massive collapse of volatility. And you can talk about this. You guys trade options. You learn about IV and volatility. Look at this. When the distance between the bull zone and bear zone is minimized to 1 strike, the market is very liquid, okay? When it's wider, the expected range is wider and the volatility is high, volatility is low. Illiquid, liquid. Didn't we say that's going to happen after FOMC? Remember, liquid Google. That Friday was the next expiration after FOMC. You have IV built in those options. The volatility is really high. This is a volatility move. And now the FOMC is over. Do you guys see how the volatility collapsed? Google is still bearish at 90 for Friday, 91. Let's see what Google looks like next week. More volatile, 110 to 97, right? So I'm going to show one day and the next. 110 is the bull side. 97 is the bear side. So there's not much of a change on the next week. Monthly map is a very powerful thing. I plan all my swing trades this way that you were asking about swing trades. Remember, make sure you guys go to the link below. Rocketscooter.com will give you access to our platform This monthly map is how I pick my strike, how I pick my expiration, and deciding if I want to long or short the market. Long or short options, not just long or short the direction. Do I want to be on the sell side or buy side of options? So comparing one day to the next, I'm showing you on the liquidity map here for Google. This is the monthly expiring options. Most of your institutional positions are going to be protected with monthly options. They hedge them month to month. Select the dividend, 107.5. Okay, so let's make a quick assessment of this. Two rules of thumb. If the distance here changes, it's less volatile. That's volatile. Volatility is the distance between these ranges. If they're tapering, volatility is getting smaller and smaller. As you see going into Fed, the previous map I did showed volatility getting wider going into Fed and then taper until later. So now volatility is lessening, and volatility is equal to the inverse of liquidity. Liquidity is what you want to ward off a bear market. So less volatile, more liquid. Google's more liquid. From yesterday to today, this expiration is more liquid. This expiration is more liquid. This expiration is more liquid. Hold on one sec. Do you guys see that? So when this is tapering, in general, I can say that the change after FOMC to today, the market is more comfortable being less volatile, which means the range is going to dry up. So that's clue number one, that the market might bottom out technically. You can see that Wall Street's it doesn't mean it's going to be bullish, but it's very easy to see that going even till monthly expiration, that the market is volatility is going down. You can see that on this, and this. Questions so far of that? That's how monthly map works. ACP will be 40 in January, not a grandpa yet. Monthly map from video, yes. So do we understand that volatility for this, and this is going down? So as time plays out, from yesterday to today, all your IVs have crunched. That's what it's showing you. There's your crush right here. Right? Your IV's collapsing, and that the rocket suit will show you that. Okay. Number two is if you were to take the exact distance, and this is the current. The one on the left is what the map was yesterday, and the one at the right is how it's modified today. We do them every single day to look at the difference. The distance between here and here is 1. The distance between here and here is 8. The distance between here and here is 13. So in general, from this period to that period, it's becoming more volatile than here, even though all of them together are less volatile than they were the day before. Inside of this week, volatility is higher. Volatility is going up. And this week, volatility is going down. Okay. When volatility is going up, I like to be on the short side of options. So inside of here, volatility is going up. If I'm say that I want to long the market with high volatility. Well, as you're getting wider over the days from here to here, your premium's going to go up a little bit because of IV. Being on the short side of the market will allow me to capitalize that. So instead of longing calls on this day, this day, this day, or this day, or this day, instead, somewhere in here, when it's at the peak, I want to short something. If I'm a bullish, I'm going to short a put. If I'm bearish, I'm going to short a call. So an example is that when volatility is getting bigger, inside of these days, I want to make a trade and enter Google. Instead of trying to bet on the direction and longing a put or longing a call, instead I'm going to be on the sell side. Big volatile range. So as week over week, the time is getting bigger. In here, I'm on the sell side of options. As volatility is getting smaller, week over week, I'm gonna be on the long side. So an example is, say that Google is like playing around in here, right? instead of longing a call and longing a put for directional movement, this is showing that it's going to be volatile and choppy. Instead, I'm going to sell calls above here or sell puts below here if it's in the middle. If on this day Google's trading down here and we're on the bear side, I'm going to sell calls up in there to bet that we don't break into bull territory without a catalyst. Where's the catalyst? There's the earnings. There's the Fed. No catalyst for the rest of the month. So I will just sell that the market doesn't spontaneously break out or spontaneously crash without a catalyst. Easy as that. If I wanted to buy the dip on Google, say that Google stays in bear territory and stays in bear territory and stays in bear territory. Google is still bearish along this path. If it's 90 by Friday and 97 by next Friday and 105 by the following Friday, it's still in bear territory. So no matter what I'm doing, I know I'm not betting on the market rallying. So if I'm going to be it's in bear territory, I likely want to sell calls up here. And as it's collapsing and Google's up here, I might want to buy puts and stop out of them there. So I'm a long puts as volatility is collapsing. I'm going to sell calls as volatility is expanding. Very easy to do. The election, yeah, there you go, right? And that's it. So now the monthly map will show me where Google breaks out to be bullish right here. If Google, we don't bet that you break from bear to bull territory. That takes place about 96% of the time. You don't break through the gap without a catalyst. I mean, we've measured that on the S&P. Pretty measurable. So if Google rallies to here on this expiration day, 90 is still bearish that next Friday, and 90 is still much more bearish the next Friday. Bears are shorting even higher. So this is still bear territory. And when you squeeze on like gamma squeezes, you expect it to hit the bear zone, and that's where my profit target is. When do I close my position? Well, in this week, if it hits here, or this week, if it hits here, or this week, if it hits here, whichever one happens, I'm going to close. Okay? Because I'm not going to bet we go from bear to bull side. Do we all understand the difference now? Without a catalyst, you have everybody in town to go from bear to bull. Not possible. So I'm looking at just these bars here to the right. At best, I'm going to hope for a squeeze to there by this Friday, or a squeeze to there by that Friday, or a squeeze to there by that Friday. My options are on the 9th of December, which is way out here. I got plenty of time to hit 100 strike on my Google. Plenty of time. But I'm not betting that it keeps going up higher. As a matter of fact, I won't hit my 110 strike in 2 weeks. If I said I wanted to buy this, or sorry, 100 strike, if I wanted to buy an example, say that you picked your profit target on Google, watch our picking profit target videos. And I said I wanted to pick a strike. I wanted to long a call at a 110 strike. Now monthly map will show me where to get it. Let's fast forward 1 week out. Can we go 1 week out? Look at the 25th, which is literally the next Friday. Look what happens. Look at the parity change. It's flip-flopped. Weird, right? For some magic reason, after the 18th, it is very, so when the other side of the coin, this is hella illiquid. And they're flip-flop. Imagine this, okay? When it's drawn like this, these are puts, these are calls. When the market's in the middle, I want you guys, this is your first day here. Calls are where bulls are, right? So this is where all your real bull positions are. Puts are where. Do you guys like this style of analysis? Are y'all enjoying this? Hope you guys are. Tell me this. Calls are where your bulls are on that date. Puts are where your bears are. I want you guys to tell me and type it in chat. Do your best guess. That's how you learn. So today, what we're doing now, we usually do in Zoom, but today I'm doing it in YouTube just to kind of show you what it's like for the members. After we do our trading in the morning for about an hour on YouTube, we go to our Discord and we post a Zoom link, and we do this for like 2 hours, and we clip these videos into like small segments for y'all to watch. So this is an educational type training session we will usually do on Zoom. This will be the only day we do this. Normally I'll be out of here by now. So if bulls are up here and bears are down here, tell me about the state of everybody's trade if price is right here in the middle. I'll teach you about liquidity really quick. If price was magically below the bulls and above the bears, what's happening to all those bulls and bears at that moment in time? What do y'all think? Yeah, I will talk about that, Brandon. And long story short on Google is that I believe the market's going to rally through the end of the year, and I picked the worst fucking things I can find that had the most to gain. Arbitrage, mean reversion, everybody's happy. Hilarious, Travis. And Travis is just joking. Everybody's losing their trades. Both sides are losing. Sandy, nice job. Do y'all see that? In the middle, both sides are losing their trades to the house. It's called liquidity, and liquidity is the maximum squeeze point of all traders. All the bulls and the bears are losing, and market makers are cashing out. They got no risk in the table. They're balanced. They're doing very little activity to stay balanced, and buyers and sellers are in very close proximity. The maximum loss point to you is the maximum liquidity of the market. Isn't that crazy? Right? It's where you are upside down as a bull and you're upside down as a bear. And the only person, the way that you leave that range is that bears close their bear shorts or bulls leave their bear shorts. In the middle, if somebody enters a trade to new buy, a new sell, unless there's a catalyst, you will not leave that middle because buyers and sellers are in close proximity. So the market makers don't need to move price anywhere. You buy, someone else is going to sell because everyone's collapsed in the same area. So you don't ever leave here until there's a massive squeeze of one position exiting. It takes an exit to leave that. Hold on a second. Okay. So in the middle, we call this a liquidity pocket. When the market hits a liquidity pocket, it's very balanced. As a matter of fact, even squeezes like to find liquidity pockets. And again, we don't bet that things go bullish. They're on the bear side. So a lot of things that you'll notice about liquidity is that in the middle, the market's stable. On a daily setup, pretend that there's a bull long setup today on SPY or whatever you have. Let's pull up Rocket Scooter again. Do you see how the same thing is shown here? Call walls and put walls. In the middle, the market is very balanced and liquid, and we call it random. So the minute you tap the middle between a call and bull zone where the call is on top, it's a liquidity pocket. Market tends to want to float to the middle and stay there until it doesn't. The reason you exit a liquidity pocket is always people exiting the trade, so therefore it was shorts covering to push the market higher, and we broke through hedge pressure. When the orientation is the other way around, it's called an illiquidity pocket. The opposite is true. Everyone's winning and the house is losing on both sides. So here, market's liquid. Bulls losing, bears losing. House is winning, market stays stable. Here, your bear and your bull are both what? In the middle. Appreciate you, Angel. Premium decay. Yeah. You guys were talking about that thing earlier. So the bear, if you're in the middle here, all the bears are winning and all the bulls are winning. Everybody's winning. So in illiquidity pockets, the market does not want to hold the middle. It wants to get the fuck out of the middle as fast as possible and squeeze out one of those trades. So both sides wise up and close to the house, right? It's the other way around. It will jump rapidly from one side to the next until a buyer or seller imbalance is found again to push one trade into the other to force liquidity. So While when they're reversed and you're opening, like say the day opens in the middle, it tends to stay close to the middle and reject both of those sides. When it's the other way around, pretend that it's like this, it's not the case. And I'll draw it for you real quick. I'm just gonna draw it like that. So say that the day opens here, it will tend to want to bounce to the middle. And the minute you pass through the middle, we say day's over. Again, we sit out and stay out. It's likely going to stay in there. It's going to, oops. It'll likely hit the wall and go to the middle, hit the wall and go to the middle. It's going to want to float near the middle. Instead here, if the bull market rallies right here, it's not going to flood to the middle and hold. This thing is going to rapidly jump to there, and rapidly jump to there, and rapidly jump to there. This guy is going to go to the middle, go to the middle, go to the middle, go to the middle. Being illiquid as the bulls are squeezing into bears. Once the bears get squeezed, they're going to buy, and then there's your buy imbalance bumping into the shorts. As everybody's buying, dealers going to drop the price. Look for sellers in the same mechanic. The sellers would be all of these bulls that just bought through here that are now upside down. You can simulate liquidity by bouncing between the two zones. So in the illiquidity pocket, the market will run fast from one side to the other, okay? And bounce rapidly between the boundaries instead of hug the middle. Do we got it? Okay. You don't know which way stocks will move. If they knew which way stocks would move, they would easily put the price there. Let's get back to Rocket Scooter. Now we're getting a good long signal here today. Market's nice and steady. Resilience is now positive. You go to the Discord, I'm sure people right now are talking about resilience. In our trading chat room, which you'll see very rapidly here, everyone is trained today. I'm watching people saying, market's irrational, super smart. Talking about numbers, market's irrational. What are you talking about resilience right now? Look at that, right out the door. That's greater than zero. People here are trained. They understand this. This is the good sign we look for, right? Okay. Now, back to the map, and I'll do a couple more on some of the stocks you guys gave me, but I encourage you to all go and check out the platform right now. Get the Rocket Scooter app. It's, like I said, our price point, if you're one of our first 1,000 members, which we're getting close to, we'll have that done by the end of this year. You can grandfather in $100 a month platform subscription for life. I mean, insane value, because it pays for live data feeds, real-time data, all the application, all the tools that we have, the community, the teaching, educational sessions like this, 2 hours a day. I mean, we do this every day for the last 6 years. It's all part of it, and it's going to be $100 a month, which is half the price for the rest of your life. You can grandfather it in. You go to your gym and your friend has like $50 and you pay $150 for it. He's like, oh, I got in when the gym opened. Never canceled. So you don't cancel. Our final product of $300 a month with all the crypto and all the futures and all the bells and whistles in it, you'll be at $100 a month forever as long as you stay a sub, which we want to reward our first 1,000 people with that grandfathered in price. Okay, so now Google. Picking price targets is a video I encourage everybody to watch that shows the four main calculations I use to pick price targets. The first one, let's load Google up front and center, is monthly walls, okay? So I go to Rocket Scooter. This is the same as a classic app, but now I'm gonna do it on, and we have that widget here. It's the same thing. I'm gonna go to Google. I'm gonna click monthly, and I'm gonna see if there's any monthly resistances along the way. I'm gonna help pick a target first. I'm gonna use the monthly map to see if that target's achievable and when it's achievable. So at 85, if I want to be bullish the market, I don't bet that Google breaks into bull territory without a catalyst. So the highest high on the monthly scale is 107.5. That's the highest I can hope for until, again, we're in a liquidity pocket, which likely will best hug the middle. So in a conservative sense, I choose for that particular method 107.5 is my target, is a bear zone. bear monthly zone boundary or wall. Okay. So that's one target. Gap fills are another. Do these very quick. So 107.5 is one of them. Gap fills are another. Well, the last gap fill we'll see on Google is 96. So we can pick some. Let's pretend I'm going to do the trade now. We have about a 96 and some change. Let's round down to 96 for that gap fill. And of course, whatever that one is. Just filling the gap off of imbalances, right? The earnings gap. 104.4. Or 96 gap. Red lines and yellow lines. It's a different technique. Last 3 days, we've had some pretty good selling in Google. Shorter term runs and imbalances. We'll see if we have any off of these yellow lines and red lines, right? So Google's red line is probably like 88 and some change. We got a lot of them on the way up. So short-term pivots are going to be there. So assuming that none of those are the target I wanted, let's just pretend that I want to get a target for longer time out. I've got a bear wall, and we know that these change little by little as I showed you on monthly map. This might migrate a little bit. These gap fills are stagnant forever. So good price targets are always gap fills, 96 and 104. Okay. Back to the map. First thing you do, where are we now? We're in bear territory for the next expiration. Therefore, we don't bet the bear becomes bullish. So this is the max for here at 92.5, I think. This is the max here for 98. This is the max here, 108. If I wanted 107.5, it's not going to happen here or here. Do we all understand why that is? We got to break into bull territory or break out of bear territory to get there. Not necessarily possible. If I want to hit that 107.5 bear wall that's circled on the bottom right of the screen, it needs to appear in the bear territory that we're still in, which means here. So for me to buy a call at 107.5, it needs to be at least here, expiration, or later. Do we all understand that? Because 107, you got to break out of bear. You need a catalyst to get there. What's going to catalyze Google in a week? Nothing. Nothing. Elections, maybe not. Right? If I'm on the bear side, I need my target to appear also on the bear side. If I'm in the bull side, I need my target to appear on the bull side. Easy as that. Do we understand? If I'm bear buying calls or bull buying puts, whatever, if I'm longing the market, I need that strike that I just chose 107.5 to get that bear wall. Then I need at least this expiration or later to go. I need the 18th or later. I need my target to appear in bear territory. Well, 107.5 is in bear territory there, and it's also in bear territory there as well. Are y'all understanding this? Yes or no? Are we on the same page? Oh yeah, we only get 5 weeks out on the chart. Everybody understand that? So now, and again, I do this a lot faster than this, and the new monthly map when it comes on Rocket Scooter will be very, very intuitive to show you guys how this works. So we all understand that I need my target to appear in the same regime we're already in. If we're in the bear territory, and I pick my price, and I have to come in here and tell me when I want to see it. Well, it's certainly still in the bear territory here and here, because we bet that if the market squeezes on a gamma squeeze, at maximum, it'll hit here that week or here that week or here that week and reject. My sell is if we touch each one of these boundaries. So say that I bought the 100s, right? And Google today rallies to 92 and hangs right here. Tomorrow, I will liquidate all of my 100s at the best price I can get on that day. And then on Monday, I will reposition into a new trade because it has exhausted the move here. If we're still trading through here and we close that Friday and I'm still in bear territory, I will hold for another week because I expect the market to need to touch a bear edge to confirm it's still bearish. So if my hundreds are out of the money, but I get a little bit of gain on them, I'm closing them. If it doesn't touch that, I'm holding on. If it touches that, I'm closing them. Wherever it touches, even if they're out of the money, I'm out, and the next Monday I'll reposition into a better target. That makes sense? Yes, if we're on the same page or no. So I can either pick my target and give myself enough time to get it, or I can say I want a 0 day for this week. I need some YOLO calls. I'm gonna YOLO, volatility is collapsing. I want to long a call. Okay. So say I want to buy Google calls right now. I got a long signal on Google. Pretend, again, not advice. But if you wanted to buy calls for Friday, what strike would you pick? Look at my chart. This is the current map right here. If I'm betting on a short squeeze that doesn't turn bullish, which strike would you guys pick inside of here? I'll put the numbers to show you the split. Let's just say it's like, I don't know what it was. 92. Take a guess. Now you understand what positional risk is about. The type of analysis that we do is called positional risk analysis, right? You're just looking at what Wall Street's doing. This is 91, and that's 92. All of you are correct. As long as you pick something less than 91, you're probably on the right side of that longing the call. Now, an example is if I wanted to sell a call, even though volatility is shrinking, selling calls is still an okay trade in a bear market. What strike would you sell your calls at? Ratish, nice job. Angel, nice job. James, nice job. Okay. Where would I sell calls? If we're in bear territory, where would I sell calls? Obviously in bull territory, right? Here's a trick. Above any of this. At minimum, above here, right? Anything 92 or higher. So the idea is that if I want to sell some 0 day calls on Friday, they need to be at least here or higher for that expiration. If I'm going to pick Friday of next week, they need to be here or higher, and here they need to be here or higher. Selling calls. Okay, that's how I do it. Now, you can either pick your price target and then pick your time, or you can pick your time and go for your price, just like we did. You can do either way you want. If you're a day trader, you want your 0 days, well, here's your risk. Okay, and that's how it works. Every day you remap it and see if you adjust your position. Okay, so before Google, I bought like a shit ton of, before the Google tanked, I bought like a shit ton of everything, got a nice little return on the rally. And right here, I took a modest position in Google, like 30 calls for 110. The expected range, just so you know, is the distance between the put and wall zone. If you hear people talk about expected range, you all these equations to do it. It's not actually how you do it. So how much is, if Google's trading right here, how much will a catalyst jolt Google around? It's actually that distance right there. It's a very cool trick. Over here, a catalyst will jolt Google around like that, smaller. Pretty neat, right? And over here, it's illiquid, so the other way around. a catalyst will trigger Google into a squeeze. Y'all are learning a lot of stuff today. Yeah, it depends on expiration dates. Yeah. Pretty neat, right? Okay. As Google fell, I bought some more. And today, if market stabilizes today and tomorrow, on Monday, I'm going to buy all the rest. I chose a 110 strike because at the time, a 100 strike, because 100 is the half gap off the earnings. So when earnings happens, and I'm expecting the rest of the market to rally, as we remember from our training, half gap is typically resistance. That's what resilience is all about. So in this mode, I chose a price and it gave me enough time to get it. So the 18th, the 25th, the 4th, the 2nd of December, and then the 9th. So right here, and starting on Monday, right here, I've got this strike for the 9th of December. Plenty of time for that to take off. Why did I give it the 9th of December? Well, because the market's unusually volatile. We had FOMC widen this and elections widen this, so I can assume that we're going to have a choppy few weeks that are going to burn out premium. I bought a little bit. I bought like 250 more down here. I'm probably going to buy 1,000 more down here in a couple days. My Google position will probably be about 1,500 of these calls. I'm all said and done. And all I needed to do is go through midterms, the S&P not finding lower lows, and all we do is tap this half gap by the end of the day, or by the end of the 9th. So why did I give myself to the 9th to do it? Well, we had some I don't like to bet when markets, when the map is expanding. Don't worry about that week. When the map is contracting, okay, volatility is good. I'm longing a call, so I need volatility to shrink. Okay, let's check. Volatility to shrink, check. Okay. So I need at least these dates. My strike is not achievable here because it's not, it has to break the bull. Not going to happen. My strike, not achievable here. My strike is only achievable here or here. And currently we only let you map out 5 weeks. I'm going to open up a ticket to let us map out 8 weeks. How do you guys like that? It'd be more helpful. I just trade from month to month. I don't like to bridge past another month's expiration, which is kind of why I don't do that. Trading takes place month to month, I promise. So I give myself like 1 extra week or 2 extra weeks after the monthly. So I need at least the 18th or later. So because when I grab the Google, here, I saw they needed at least the 18th way back in the day. So what I did was, because that was, you know, about 3 or 4 expirations, I just, to ward through all the volatility, I just doubled it and just gave myself a little more fat. Paid a little bit more of a price for it, but hey, it's going to take, if the earnings would have gone that way, it would have been a nice little, you know, 5-10K profit on that. Instead of 5 or 10K loss, and now I'm going to pile in, and if it strikes, it's $250,000. So at the end of the day, the risk is very low, the return is very high. I'll lose everything if it doesn't work, but it's, again, I made 70K last week. I'm reinvesting it back to the market. Why am I buying Google? Because it's the worst looking thing there is. Please don't follow what I'm doing. This is another thing. Don't do what I'm doing. I'm a fucking idiot. I'm taking a risk. Don't do what I'm doing. Don't follow me. Don't follow my trades. Don't say I'm doing it because Matt's doing it. My bigger plays like this, another reason I don't go out there and tell people why I do this and only in the Zoom calls is because somebody out there is gonna be like, oh yeah, let me buy the exact same calls Matt's buying. Let me do what he's doing. And you're gonna come be like, man, that trade lost money. And I'm like, well, my bigger swings and bigger thesis like this are like my private trades that I know the risk, you may not. All right, so don't follow my trade. It's very risky, but the return's very high if I'm right. So I'm gonna day trade other safer things for sure. Just offset like there's a bag hold the whole way down. Let's do Nvidia. But do you guys see how my 100 strike appears here and here in bear territory? I need this expiration. I don't choose monthly almost ever. If that's the first one it appears in, I will always go to the next week or later. So I said since we'll have basically 2 volatile weeks, FOMC and elections, then I'm giving myself 2 more volatile weeks after monthly, and then I grabbed the next expiration. Just because I'm losing premium, I'm going to add some fat to that date. If it was no catalyst for the month, I probably grab monthly. So it'd be cheaper. I can get more of them, more out of the money, higher position. That's cool. Okay. Nvidia. Okay. One more. And everybody go to the Discord after I'm done here. And we will go and talk further. Okay. Nvidia. Looks like I've already done this last week. So Nvidia has here and here. Let's go ahead and put it on the monthly. Let's bring the classic app up. Check it out. And I want you guys to go tell all your friends, especially if you guys came from the Trading Camp podcast. Let everybody know that you checked it out if you like it. We're trying to go on a hiring spree to hire a bunch of developers to build. We have a whole year's roadmap worth of tools, and all this stuff I'm doing here is going to be automated. And all your help is greatly appreciated, because as you help us build the thing we want to build, we can build it faster. The faster we grow, we can hire more people. We have a bunch of people we're trying to hire, and we would love your help. Please get the word out, retweet, tell everybody, man, dude, I checked this thing out. I like it. It's new. There's a free trial. No credit card required. You can just sign up. Check it out. Okay, Nvidia. This was yesterday's map, and today's map is here. Nvidia is more liquid, less volatile. Nvidia is also mean reverting for Friday, neither bullish nor bearish. And you shouldn't be confused why it's hugging the middle already. This is a great de-risking tool. Originally, we're going to call ourselves the world's first risk management platform, because we technically are, but risk management just doesn't sound sexy enough to really be a good selling point. But in reality, we are the world's first risk management focused theme set of trading tools. It's all about managing risk and understanding why markets move instead of trying to predict where they move to. You understand why markets move, you have better handle and grasp on your risk. And it's the engineer's way. I mean, for me, things have to make sense on paper. Technical analysis always just seemed like a glorified crapshoot. Delayed signals by itself was very hard to predict much of anything. So this is very opposite of Google, as you see. Wait, 100, 110. Let's make sure I did the previous week right. 115, 110. Hold on. Oh, let me draw like this. 115, 110. Okay. Keep mapping it out. And as you can see, Nvidia, I'm showing the change from one day to the next. It might be a little confusing. It's your first time to see it. It's the walls to the right are the change from one day to the next. Just to show that I'm looking to see how the difference between yesterday and today is affecting the map for the month. So this Friday is here. And it'd be so nice if I could just click a button called monthly map and it works. And as a matter of fact, it's something we're making now. So help get the word out, and we love you guys if you can. Okay, Nvidia, balanced here, right? Balanced and liquid. Nvidia, still bullish here, still bullish here, still bullish here. If I were to buy puts on Nvidia, being that we'll be bullish next week, my puts only can touch there or there or there. Nvidia is, as long as we close Monday above 115, Nvidia is bullish, and I will buy the dip at 115 to some strike. So because Nvidia is currently balanced, it was bullish yesterday, but post FOMC it's certainly balanced now. Likely on Monday, unless Nvidia collapses to like 115 points, which won't happen in 2 days, I don't think, then I'm now bull-minded on Nvidia. Even though Google, I was buying calls into a bear squeeze because I believe the index is going. Let's pretend we want to be bearish on Nvidia the other way around. Pretend you're still a bear and market closes here, and then on the next Friday, the maximum amount of fall I expect is the edge of bull territory. So my puts would need to be here for this date, or here for that date, or here for that date, or higher. As the volatility is not getting much different, slightly expanding into the end of the year. Okay. So Nvidia either falls into a nice little cushiony trap somewhere down in here to finish off the year. Inside of here, I would sell puts and sell calls. All through here, I would buy puts and buy calls for whatever side I want to be on. Let's do predicting price targets. Again, avoiding, you know, red lines and yellow lines for now. Let's just look at gap fills. Here's one, here's one, here's one. I've already marked it. We did it yesterday, I think. Let's also look at monthly put walls and call walls on the monthly scale. This is always another trick. It's in that video predicting price targets, but I look for resistances and supports on that monthly scale. So if I go here to the 18th, fresh, there is no resistance on the bull side and there is no support on the bear side. So we're unbounded to the upside and unbounded to the downside if it were to break out. So the Nvidia wall, let's go back to the bull side. Say that is bullish and I want to be bullish. I'm looking for any put walls on this expiration day. This is just the trick. Monthly is where you really gauge your risk at, month to month. That's when the asset manager is doing it too. There are no put walls above 110. Great. If there were a put wall, that'd be my strike. Number 2, gap fills. I take the first one I see, 145. Okay, there's no put wall as a target, no. So let's do gap fill, right? Gap fill, 145. So I need calls, so I need 145 to appear in call territory. Well, check, 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 and check. Any of these dates will do. I have to pick one. What do I do from here? Oh, there's another trick. Okay. Two ways to do it. Number 1 is on Monday. I just buy them by default, at least, this is for swinging, at least a month out, just because, for default. If I need to pick a date, at least a month out. When the bull side gets lower and lower, people are more comfortably bullish as that bull side is lowering. They want to buy lower. It's becoming more and more bullish as it's lowering. So the lowest one is the highest probability. You got the most bulls behind you. Your strike. So this is the strongest bull push. And it's also the most travel. So therefore, if I were to long those calls at this point in time here, and it falls to there, on this day, I'll buy some more calls. And on this day, I'll buy some more calls. For what strike? I mean, for what expiration. Again, a month out or greater. Because I have no limitation of, or no, anything is telling me when I'm going to see that resistance. I'm actually not trading bull into bear territory. This time I'm trading bull into bull territory. So the biggest percent gain I'm expecting to get on this trade is going to be somewhere in this week, because that's the most travel. So therefore, if I were to long right here, the market were to fall and I long some more, the market were to fall and I really dive in, that's the date with the most travel. That's the date I'll get the most out of my trade, hopefully. Now, this could continue to rally and then I'm good as gold, but I need to make sure they understand that it could still fall and still be bullish, and still fall and still be bullish, and then people are less bullish after here. So if I don't start getting my trade here or here on that travel I want, I'm likely to close out, but hopefully this is travel to here to maintain bullishness. If we're here, it's mean reverting, I'm Xing out of the trade. So if I'm bullish, we need to stay on the bull side. And when do I expect the biggest run of this trade is going to be from, not from here to here, here to here, and here to here. This is the biggest run, so this is my biggest dig in to that position. Because it's on this date, I don't want this expiration, because I don't want to buy 20-cent out of the money options and expect us to travel this far in a day. So now I'm going to do step 2 is 110 to 145 is 35 points. How long does it take Google to travel 35 points in a choppy market? Let's do the worst case scenario. This is my favorite thing to do. 110 to 145 took from a Friday to 3 Fridays later, 3 weeks. So therefore, if this is the longest run, you just need to pick a date a month out. I need 3 weeks or greater to achieve that distance in a choppy market. That is the trick, because choppy markets lead up your premium the most. Because I want to be ultra conservative, I just multiply it by 2. And therefore, I'm going to get 6 weeks out after that monthly expiration. So I will pay a lot more to hopefully not have to deal with a lot of volatility. This is my biggest run date, so I don't want to be way out of the money, expect 35 points in a single day. If this is my biggest run, I would need at least, I'm just measuring how long it took to go 35 points, about 3 weeks. Okay, I need 3 weeks from here to do it. And in 1 week, I need to go from 110 to 120. I need 10 of those points just in the first week after expiration. If I don't get this, I'm closing my trade. Again, I'm just mapping out my options, date and time. And the more you do this, the more you see it. But this is monthly map. And pretty soon on Rocket Scooter, you'll just click a button and it will draw the monthly map for you. And that's it. You guys like that analysis? Hopefully you guys like that. All right. Okay, everybody go to Rocket Scooter Discord. Get the platform. No Zoom today, but if that Rock Studio Discord, I'm gonna call it a day. I'm gonna come over. You guys come later. If you liked what we did today, do me a favor. Go share that podcast that I was on. Retweet it. Give some props. Go out to your communities you've been in. Spread the word so people come to the stream. Free. We drop nuggets all day long. Doesn't mean taking a dump. We hopefully drop golden nuggets. Teach you guys risk management, position management. Like I said today, market was irrational. Didn't make any day trades. Wasn't excited to do much. Markets jumped back into being rational. Let's go to liquidity map on SPY, finish out the day. Using 0001 setting with shares? What do you mean by that? If the call wall is moving down each week, that means bulls are more comfortable at a lower price on that week. So imagine if I wanted to buy at 110 today, you were like, no, I'm going to buy it at 100 like next week. It means when people buy lower, they're more bullish, right? That's the way I see it. But at a later point in time. If all things are equal right now on the same date, if I want, let me try and say that backwards. If I want to buy at 100 today and you want to buy at 110 today, I'm more bullish than you. So the lower price is the more bullish price. I'm willing to jump in lower because I'm more bullish than you are at this price. You need more confirmation on the same date today. Again, I'm not bullish till 120. Then you're not that much of a bull. I'm bullish right now at 80. Then I'm more bullish than you are. As time goes by, if you're like, I'm going to buy at 100, and I'm like, yeah, I don't like 100. I like 90. But I need to give it some time to get there. Then I'm more bullish on a time factor. That point in time, if you bought at 100 and it dipped to 90 and I bought at 90 and it goes to 100, you're less bullish than me because you were negative and just broke even. You're likely going to trust the trade less than me who won. So I'm more bullish because I bought lower later. Thinking about if you bought and you're upside down, you come back to the middle, you might be less bullish. You might have squeezed out and abandoned your bull position before that. If you go up, like if the market is 100 at the bull side this week and 110 next week, it's a combination of the two. There are people that are less bullish because it's they need a higher price to confirm their bull side. They also need more time. So they're less bullish longer out. So the bull side fades as time goes by. Easy way to think about it, I guess. So if the call wall is moving down each week, you tell yourself it can dip further and still be bullish. So if I was a bull, I need to make sure that I understand I can buy lower and still be on the bull side. So if the further down it moves, I need to make sure I'm not all in too soon. I can get in a little later. Okay, I'm gonna call it a day. Go to rockscooter.com. Go to the Discord. In 10 minutes, we'll still be there chilling, hanging out. Go there now. Love you guys. We'll see y'all tomorrow. Promise. It's the longest stream we've done. Rock Scooter Discord, rockscooter.com. Go there, free trial. You guys are gonna love it.